Welcome to video 4 of part 1 of the EA Tax Training free EA exam prep course for 2026. Tom here, back with you to discuss adjustments and deductions. The 2025 tax law, the OBBBA, did make significant changes to this material for 2025, probably more than in any of the other videos in this course or topics on the exam. Specifically, what we will cover in this video are adjustments to income, standard deduction, the itemized deductions, and then the 4 new deductions that were added by the OBBBA, the qualified tips deduction, qualified overtime deduction, the new car loan interest deduction, and the enhanced deduction for seniors. Then we will finish up by talking about the qualified business income deduction, or QBID. Your free resources from irs.gov, we've got quite a few for this video, 2 slides worth. The first 2 you'll recognize from our other videos. Then in bold, we've also added Schedule A of Form 1040, which deals with itemized deductions, along with the 8995A and the 8995 and their instructions, which are the 2 forms that are related to the qualified business income deduction. And then you will see the rest of these as well on this slide and the next. As far as our flow of the tax return goes, we have moved on from income. We will cover quite a bit of ground in this one, talking about those adjustments to income. When we subtract those from gross income, that leaves us with that very important adjusted gross income number. From that, we will subtract our other deductions, which will leave us with our taxable income. Throughout this video and just in the tax world, you are going to hear people referring to above the line deductions and below the line deductions. When we say that, the line is adjusted gross income. So adjustments to income are also referred to as above the line deductions. And then all of the other deductions, the standard deduction, itemized deductions, those new deductions that have been added, the qualified business income deduction, those are all below the line deductions. So when you hear that term, that's what that means. So let's start with those above the line deductions, the adjustments to income. You report the adjustments to income on Schedule 1 of the 1040. It is Part 2. So let's zoom in. And you can see at the top here, it starts with educator expenses and then moves on down the list. We will be talking about most of these, the ones that are the most likely to be tested on the EA exam. And then when you add them all up, they then flow over to the Form 1040. So let's start with those educator expenses. Eligible educators can deduct up to $300 of eligible expenses per year. This is for kindergarten through 12th grade teachers, instructors, counselors, principals, or aides who worked in a school for at least 900 hours during the calendar year. If a couple is married filing jointly and both of them qualify, so they're both educators, they can then each take up to $300 for a total of $600. The expenses that qualify are unreimbursed, ordinary and necessary expenses for professional development courses or books, supplies, equipment, and other materials used in the classroom. And it also still includes personal protective equipment, disinfectant, and other supplies to prevent the spread of coronavirus. If you have clients who are teachers, counselors, etc., you want to make sure to ask about this. Most of the time, they will have at least $300 worth of expenses. They put a lot of their own money into their classroom, so it can be a great deduction for them. Do note, though, it does have to be kindergarten through 12th grade. This does not apply to preschool, does not apply to college, K through 12 only. It also does not include expenses for homeschooling, and it does not include expenses for non-athletic supplies in health or phys ed courses. Our next adjustment are certain business expenses for particular categories of taxpayers. So members of the National Guard and Reserve who traveled for more than 100 miles from home to perform their service, if they had unreimbursed expenses, they can deduct those as an adjustment to income. Also, expenses for qualifying performing artists and fee-based state or local government officials, their business expenses can also be deducted as an adjustment to income. For the exam, you do not need to know exactly what qualifies for this. If you are interested, you can see the instructions to the Form 2106, which is the form that is used for those individuals who are deducting these expenses. Our next adjustment are medical account deductions. First of all, the HSA deduction. So this is for contributions to your health savings account that were not either made by your employer or that were not taken from your paycheck on a pre-tax basis. So if you work for someone else, you're an employee, and you have a health savings account, then chances are your contributions are taken out of your paycheck. So you would not then count them as an adjustment to income because they have already been deducted from your income. On your W-2, they will not be included in your W-2 wages. So you cannot then deduct them again as an adjustment to income. However, for instance, if you are self-employed, and you have an HSA and you're making contributions to that HSA, then this is where you would deduct those. And it is also possible for an employee to make extra contributions outside of the ones from their paycheck. If they do that, then this is also where they would be deducted. Then we have these Archer MSA deductions. These are older accounts. You cannot actually start a new Archer MSA account. But for existing accounts, contributions to those are also an adjustment to income, again, as long as they are not taken out of a paycheck on a pre-tax basis. So this is where you would show those. Continuing with our theme of health insurance is the self-employed health insurance deduction. This will likely be tested on the exam. If you are self-employed, you may be able to deduct the amount that you paid for health insurance for yourself, your spouse, and your dependents. So you must be both self-employed and not eligible for subsidized health insurance from either your or your spouse's employer. So what is subsidized health insurance? That means that the employer is paying part or all of the costs of the health insurance, which is typical. If you have health insurance through a job, most likely the employer is paying part or all of the cost of that insurance. Even if you are paying some out of your paycheck, first of all, that comes out on a pre-tax basis, so it's already deducted. And secondly, likely your employer is also paying part of the cost of that. So if you have access to that subsidized health insurance, then you cannot take the self-employed health insurance deduction. And notice here, it's that if you are eligible for it, even if you don't take advantage of it, if you could have, but chose not to, you still cannot take the self-employed health insurance deduction. You cannot have any type of access to that subsidized insurance in order to be eligible for the self-employed health insurance deduction. Now, you may be eligible in some months and not others. So let's say you have a job, you have insurance, and then you quit the job and start your own business. Well, for those months that you do not have access to that subsidized health insurance, you can go ahead and take the deduction. For the months where you did, you cannot take the deduction. And then also, you must have a profit from your business in order to cover the deduction. In other words, you cannot end up with effectively a loss from your business by deducting your self-employed health insurance. The best you can do is get to zero. So the amount of the self-employed health insurance deduction cannot exceed the profit from your business. Moving on to alimony paid, we talked about the flip side of this when we talked about income. So alimony payments made under a divorce or separation agreement entered into prior to January 1st of 2019 can be deducted. So remember that date. If the divorce was 2018 or sooner, you can deduct the alimony payments, and they are deducted here as an adjustment to income. If the divorce was January 1st of 2019 or later, then you cannot deduct those alimony payments. Also, if you had a pre-2019 divorce and then you went back to court and amended that divorce agreement in 2019 or later, and as part of that amendment, there's language that says that the alimony will not be included in the income of the former spouse, then you cannot deduct it. So for a pre-2018 divorce, the one paying the alimony can deduct it. The one receiving it has to include it in income. For a post-2018 divorce, the one paying it cannot deduct it. The one receiving it does not have to include it in income. Next are retirement plan deductions. So if you were self-employed, you may have made a contribution to a SEP, a simple, or a qualified plan. We'll learn all about those more in a later video. But if you did make contributions to those, you are able to deduct those as an adjustment to income. Similarly, even if you're not self-employed, you may have made an IRA contribution that qualifies for a deduction. This is where you will deduct it. Again, we will cover that in a future video. Student loan interest. Student loan interest is deductible up to $2,500 per year if all of the following apply. You paid the interest on a qualifying loan, you're not married filing separately, and you are not claimed as a dependent on someone else's tax return. Now, the deduction does phase out between $85,000 and $100,000 of adjusted gross income if you are any filing status other than married filing jointly, and between $170,000 and $200,000 if you are married filing jointly. In other words, let's say you're single. If your AGI is under $85,000, you can deduct up to $2,500. If it is over $100,000, you cannot deduct any student loan interest. And if it is in between $85,000 and $100,000, then you can deduct part of the amount. Parents can only deduct their student loan interest if they are liable for repayment on the loan. In other words, if their name is on the loan or they co-signed on the loan. If the loan is in the student's name only, then the student can deduct it even if the parents pay it. So if the parents are making the payments, as long as it is in the student's name, the student can deduct that interest, as long as that student is not a dependent on the parents or anyone else's tax return. What is a qualifying student loan? It has to be one you took out to pay for qualifying higher education expenses for you, your spouse, or your dependent, or someone who could have been a dependent except they meet one of these exceptions that we have spoken about before. Then the proceeds must have been used for tuition, fees, room and board, etc., for education in a degree, certificate, or similar program at an eligible education institution. So most of your standard college, universities, tech schools, they will count. And notice here, it does count for loans taken out to cover room and board. We'll talk in a later video about some of the education credits where room and board expenses do not count, but for student loan interest, room and board does count. Our next adjustment is certain attorney fees. So attorney fees and court costs for actions involving certain unlawful discrimination claims can be deducted as an adjustment to income, but only to the extent of gross income from such actions. In other words, you can't deduct more than you recovered. So if you have an unlawful discrimination claim, you hire a lawyer, you go to court, you win, you include the amount that you won in your income in the year that it is received, but then you can take an adjustment to income for the attorney fees and any court costs that you had in order to get that amount. It's just that the fees and costs cannot be more than the income that you are including. Similarly, for any attorney fees or court costs that you paid in connection with an award from the Internal Revenue Service for information you provided that helped the IRS to detect tax law violations, you can deduct those up to the amount of the award includable in your income. So this is known as the whistleblower awards. So if someone knows that another person is cheating on their taxes, they can actually go to the IRS and say, hey, this person is cheating on their taxes. And as long as they provide enough information, like they've got details and they can explain exactly what they're doing, and assuming that the IRS doesn't already know about it and isn't already investigating it, if the IRS goes in, does that investigation, recovers money from that taxpayer who is cheating, then that whistleblower can get a percentage of that. So this will happen frequently with employees who get mad at their employer or their former employer, and they go to the IRS and they report them for cheating on their taxes. If they do that, they can get anywhere from 15 to 30% of the amount recovered. That amount that they receive is taxable income, but if they had any expenses incurred in getting that amount, they can deduct those as an adjustment to income. Next is the self-employment tax. This will be tested on the exam. You can generally deduct 1/2 of the self-employment tax that was paid. So this represents the employer's share of Social Security and Medicare. So other businesses, if you have a business and you pay employees, remember we said as the employer, you have to pay from your own funds 7.65% of that employee's wages in to Social Security and Medicare, where those businesses, they get to deduct that amount as a business expense. So what this adjustment to income is doing is putting self-employed people on the same footing. They get to deduct 1/2 of that self-employment tax that represents the employer's share of Social Security and Medicare. So this is where they deduct it. They don't deduct it on, for instance, their Schedule C. They deduct it here on the 1040 as an adjustment to income. The next adjustment is moving expenses. So if you are in the military and you get an order to move and you have unreimbursed expenses related to that move, you can deduct those as an adjustment to income. It used to be prior to 2018 that anyone who was moving for work, if they met certain distance requirements, could deduct their unreimbursed moving expenses. But these days, that is not the case. It is only for members of the armed forces. Our next adjustment is a penalty on early withdrawal of savings. So we talked in a previous video about a certificate of deposit. If you took the money out early, you would have a penalty. So that would be an example. If you have to pay that penalty, you can deduct that as an adjustment to income. Next is jury duty pay. So if you go to jury duty and your employer continues to pay you, but then as a condition of that, your employer says, hey, when the county or the city pays you for that jury duty, you have to give that money back to us because we were paying you your salary that day. So anything you earned, you got to give back to us. So if that happens, that jury duty pay is taxable income. So you include it in income, but then you can take an adjustment to income in order to deduct it. Next are Olympic awards and medals. Again, we talked about this when we talked about income. If your AGI is under $1 million, then the value of the Olympic awards and medals that you receive are not taxable income. But what you do is you actually do include it as income, and then you take an adjustment from income, making it not taxable. So as long as you are under that $1 million mark, you include it in income and then deduct it as an adjustment to income. If you have an athlete who is over that $1 million mark, then they include it in income, but they do not take the adjustment to income. Next are certain reforestation expenses can be deducted as an adjustment to income. Repayment of certain supplemental unemployment benefits can be deducted. Contributions to certain union pension plans can be deducted, and contributions by chaplains to Section 403B plans can be deducted. Next is the foreign housing deduction. We'll talk all about this in video 7, but if you have the foreign housing deduction, this is where you deduct it. Certain excess deductions from a trust can be deducted as an adjustment to income. And then if you receive an incorrect Form 1099-K, you can deduct that as an adjustment to income. So if you get a 1099K, remember that's from the credit card processors or the online apps, etc. You should go ahead and include that in income. But if it's incorrect, you can take an adjustment to income to deduct it. The reason you want to include it in income is because of the IRS's computer matching program. So their computers are going to know that you got a 1099K, and they're going to be looking for that income on your tax return. So if you don't report it, you're going to get a notice from the IRS, then you'll have to respond to the notice, and it's a big pain. So in order to avoid that, go ahead and include that amount as other income, and then take an adjustment to income to back it out. That way you're not paying tax on the money, but the IRS still knows that you did report it. So those are our adjustments to income. And when we deduct those from our gross income, that leaves us with that very important adjusted gross income number. So those were the above the line deductions. Now let's talk about the below the line deductions, and we will start with the standard deduction. Most people can choose to either itemize deductions or take the standard deduction. There are some people who cannot take the standard deduction. We'll talk about that on our next slide. But for the most part, you can choose each year whether you want to itemize or take the standard deduction. So you can just add up all of your potential itemized deductions for the year, compare that to your standard deduction. If your itemized deductions are higher, you can go ahead and itemize. If the standard deduction is higher than your itemized deductions, then you can just take the standard deduction. You can make this decision each year and switch back and forth each year. That is perfectly fine. So who are those people who cannot take a standard deduction? Well, first of all, if you file married filing separately and your spouse itemizes, then you cannot take the standard deduction. So you can't play this game where you say, okay, I'll take all the itemized deductions on my return, and then you take the standard deduction on your return. You cannot do that. If you're married filing separately, then you either both itemize or you both take the standard deduction. You cannot have one do one and one do the other. Next, if you are a non-resident or dual status alien, you cannot take the standard deduction. There are a couple of exceptions. We talked about in video 1, if you are married to a U.S. citizen or resident alien, then you can elect to be taxed as a U.S. resident, in which case you can take the standard deduction. And then also there are certain students and business apprentices from India who may be able to take the standard deduction. For the exam, just know that that is on there. You don't have to understand exactly who qualifies. If you are interested in knowing that, then check out the instructions for the 1040 NR. But all other non-resident aliens or dual status aliens cannot take the standard deduction. That is the main thing you will want to remember for the exam. And then the last exception here is if you are filing a tax return for a short tax year because of a change in your annual accounting period, then you cannot take the standard deduction. That is very rare. Just know that it is on the list. So how much is the standard deduction? Well, here are those amounts. This is the chart for most people. You'll remember back in video 1 when we were talking about who has to file a tax return, we had a chart for most people, and then we had a chart for everybody else. Everybody else is anyone who can be claimed as a dependent on someone else's tax return. So we've got the same thing here. You're also going to recognize a lot of the numbers that we talk about from that first video, because if people's earnings are below the standard deduction, then in general, they don't have to file a tax return. So you're going to see the same numbers. But let's look at these specifically. And this is a chart that you will want to know for the exam. It looks kind of intimidating, but I'm going to give you an easy way to remember this chart. So you want to start with your basic standard deduction here in this box where it says base. So these are the most important numbers. If you are single or married filing separately, the standard deduction is $15,750. If you are married filing jointly, it is double that amount. It is $31,550. $500. If you are a qualifying surviving spouse, remember you're treated for most purposes as if you were married filing jointly. So you also get $31,500. If you are a head of household, it is $23,625. That amount is exactly halfway between $15,750 and $31,500. So if you add $15,750 to $31,500, that totals $47,250. If you divide by 2, that gives you $23,625. So remember that base amount. Single or married filing separately, $15,750. Married filing jointly or qualifying surviving spouse, you double it to $31,500. Head of household, exactly halfway between at $23,625. Then we've got these points. You get 1 point if you are age 65 or older, and you get 1 point if you are blind. For each point, you are going to add this increment amount to your base standard deduction. So, for example, if you are single and you are age 65 or older, you can add $2,000 to your standard deduction, making it $17,750. Or if you're under age 65 and you're blind, it would be $17,750. If you're over age 65 and blind, that's 2 points. So you can add $4,000, which is $19,750. And then the rest of these work the same way. Add up the number of points times the increment, add that to your base standard deduction, and that will tell you what your final standard deduction is. If you are single or head of household, so in other words, you're not married and you're not treated as married, then your increment amount is $2,000 per point. And then obviously the maximum number of points you can have is 2. If you're both 65 or older and blind, then you would have 2 points. If you are married or treated as married, then your increment amount is $1,600. If you're qualifying surviving spouse, your maximum is still 2 points because there is only one of you. If you are married filing jointly, there are 2 of you, so potentially you could have up to 4 points. Then that leaves us with married filing separately. This one seems a little bit odd because you're filing a separate tax return. Therefore, there is only one of you on your tax return. Yet you can see on the chart here, you could potentially have up to 4 points. Why is that? Well, it's a very rare circumstance, but you could have it. If you have one spouse who's filing the return, they're filing married filing separately, and their spouse has no income, they are not filing a tax return, and they cannot be claimed as a dependent on anyone else's tax return, then you can actually take credit for their points. So in that case, you could potentially have 4 points. Again, that's very rare, but if your spouse has no income, they're not filing a return, and they cannot be claimed as a dependent on anyone else's return, then you can take credit for their points on your married filing separately tax return. Then notice the asterisk here. When we're talking about someone who is 65 or older, you actually look at their age as of January 1st of the following year, so January 1st of 2026. So if someone turns 65 on New Year's Day, they can be treated as if they were 65 in the year before. It's just a little quirk in the tax law that they do allow that. So that is the chart. So what's the easy way to remember it? You only have to remember 3 numbers. You have to remember the 15,750, the 2,000, and the 1,600. Once you know the 15,750 for single and married filing separately, you know that all you have to do is double it in order to get the married filing jointly and qualified surviving spouse. And then you can add those 2 together, divide by 2, that will get you the head of household amount. So all you need to remember is the 15,750 over here. Then remember the 2,000 and the 1,600. So remember that the 2,000 applies to those who are not married and not treated as married, single and head of household, and the $1,600 applies to everyone else. Once you have those three numbers, you can figure out any of the numbers on this chart. So that was the chart for most people. What if you can be claimed as a dependent on someone else's tax return? Well, again, these numbers should look familiar from video number 1. If you can be claimed as a dependent on someone else's tax return, your standard deduction is limited to the greater of $1,350 or your earned income plus $450. And then if you are age 65 older or blind, you add $2,000 for each point if single or head of household, and $1,600 for all the other filing statuses. So those numbers are exactly the same as on our previous screen. So just remember, if you can be claimed as a dependent, it's the greater of $1,350 or earned income plus $450. So let's look at an example. Joaquin is 15, single, and claimed as a dependent on his parents' tax return. He earned $3,500 in 2025 working at a fast food restaurant. What is his standard deduction? Well, we just talked about it. We're going to take the greater of $1,350 or his earned income plus $450. His earned income was $3,500 plus $450. That makes his standard deduction $3,950. Next is a disaster loss. If you had what is called a qualified disaster loss in a federally declared disaster area, you may be entitled to an increased standard deduction. It does have to be for a disaster that occurred on or before July 4th of 2025 and ended by August 3rd of 2025. If you have one of these losses, your standard deduction is increased by the amount of the loss minus $500. We're going to talk about this in detail later in this video when we talk about itemized deductions. But just know, if you have one of these qualified disaster losses, which there's a particular definition of that we will talk about later, but if you have one, then you take the amount of your loss, you subtract $500, and you add that to your normal standard deduction. So let's look at an example. Luke and Laura are both 45 years old and neither is blind. They file married filing jointly and take the standard deduction. In 2025, they suffered a $10,000 qualified disaster loss. What is the amount of their standard deduction? It is $41,000. So we'll remember that their normal standard deduction is $31,500, but they get to add this disaster loss minus $500. So the disaster loss was $10,000. So you add that to the $31,500, that's $41,500. Subtract that $500 and you end up with $41,000. So that does it for the standard deduction. Now let's take a look at itemized deductions. These are the different categories of itemized deductions that we will talk about: medical and dental expenses, taxes paid, interest paid, charitable contributions, casualty and theft losses, and then other itemized deductions. So let's start with medical and dental expenses. You can deduct only the part of your unreimbursed and otherwise undeducted medical expenses that exceed 7.5% of your adjusted gross income. So this is sometimes referred to as a floor because you can only deduct the amount above the floor. So it is a 7.5% of AGI floor on your expenses. So for example, if you have an adjusted gross income of $100,000 and you have $10,000 of eligible medical expenses, you cannot deduct the first $7,500 of those. You would only be able to deduct the amount above the floor. So you could only deduct $2,500 of those expenses. You can deduct expenses for you, your spouse, and any dependents. And then also it has the rule, if someone could have been claimed as a dependent, except for these reasons, then you can still deduct them. But what you want to remember for the exam is you can deduct expenses for you, your spouse, and any dependents. For a decedent, you can deduct the expenses incurred for a decedent before they died in the year incurred, as long as they are paid within 1 year and 1 day from the date of death. So let's say you have someone that dies in October of 2025. They may have incurred a lot of medical expenses before they died. Could have been in the hospital for a long time and just had a lot of expenses. Well, if you've ever dealt with hospital bills and doctor bills, you know that you may not even get the bill for months after you are in the hospital. Normally, we are, of course, cash basis taxpayers, so we cannot deduct those expenses until the year that they are paid. However, a decedent is kind of in a unique position because they've only got one more tax return to file. That's the return in the year of death. So what this rule is doing is letting you deduct those on that final tax return, even if they didn't get paid until the following year. The only limitation is that they did have to be paid within 1 year and 1 day from the date of death. So for everyone, what medical and dental expenses can they deduct? What are deductible expenses? Well, it's everything here on the slide, and I'm not going to read all this to you, but it is going to be your typical type of expenses for prescriptions, for hospital stays, for doctor visits, etc., and so forth. You're going to see other ones on here, for instance, weight loss programs that are prescribed by a doctor. Lodging, if you travel, you can take up to $50 per eligible person for your lodging expenses, but you cannot deduct meals. And then you can see the other things that are on here, but these are going to be your more typical expenses that you would normally think about as medical expenses. You can also deduct certain amounts of health insurance premiums. So you can deduct premiums for health, dental, and vision insurance, but only for the portion for which you did not get a deduction elsewhere, such as for the self-employed health insurance deduction, or for pre-tax amounts through your employer. So if you get your health insurance through your employer, that amount is coming out of your check pre-tax, you cannot then take that as an itemized deduction. It has already been deducted from your income. It's not included in your box 1 wages on your W-2. So you cannot then take that again as a deduction. But if you pay for health insurance that did not come out of your paycheck pre-tax and that you did not get as a deduction anywhere else, such as for the self-employed health insurance deduction, then you can deduct that as an itemized deduction. You can also deduct your Medicare Part B and D premiums and a limited amount of long-term care insurance. You can see the chart here. As you get older, you are allowed to deduct more. You do not need to know all these amounts, just be familiar with it and familiar with the idea that it does increase the older you get. That's because the older you get, the more you're going to have to pay for long-term care insurance. That's the insurance in case you go into a nursing home. They pay those costs. So obviously it's going to be more expensive the older you are. Capital expenses. So home improvements and special equipment can be deductible if their main purpose is medical care and the costs are reasonable. They are deductible to the extent that they do not increase the fair market value of the property. So for example, upon a doctor's recommendation, you install a bathroom and shower in the basement of the home you own due to not being able to climb the stairs, and it costs you $12,000. It increases the value of the home by $5,000. You can deduct $7,000. So you spent $12,000, but now your home is worth $5,000 more. So they're not going to let you deduct that amount because you've already gotten that benefit from it. But they will let you deduct the extra $7,000. Example 2 is the same facts as example 1, except that you rent the home. Well, in that case, you can deduct the full $12,000 because you don't own the home, so you got no benefit for increasing the value of someone else's home. So you can deduct the full $12,000. You can also deduct the cost of equipping a car or other vehicle with special controls or equipment. Now, when we talk about these capital expenses, don't get carried away. Remember, the main purpose has to be medical care and it has to be reasonable, and it's only deductible to the extent that it does not increase the fair market value of the property. So if someone says, well, I had to put in a swimming pool because of my joints or whatever, well, that's not going to be allowed. If it sounds too good to be true, it probably is. So it has to really be the main purpose is medical care and that the costs are reasonable. So, what are non deductible medical expenses? Well, here are some examples. Diet food. So, the weight loss program may be deductible, but the food that you buy is not. Cosmetic surgery, not deductible. Life insurance premiums, that's not health insurance, cannot deduct it. That Medicare tax that comes out of your paycheck, cannot deduct it. Nursing care for a healthy baby. So if you have a nurse come in to take care of your baby, but the baby's healthy, that sounds more like daycare. Just because the person happens to be a nurse does not make it a deductible medical expense. And then non-prescription medicine, not deductible, other than insulin. Insulin no longer requires a prescription, but you can still deduct it. But over-the-counter medicines or vitamins, minerals, etc., not deductible. Illegal drugs or procedures, not deductible. Imported drugs that are not FDA approved. So this is happening a lot these days. People are ordering from foreign pharmacies over the internet. Those drugs are not FDA approved. If you do that, you cannot deduct those. And then travel to rest or de-stress is not allowed. Wouldn't that be great? We could all deduct our vacations as a medical expense, but that is not allowed. So let's do a medical expenses example. John has AGI of $30,000. He works part-time with no health insurance benefits, making $25,000, and he's also self-employed, making $10,000. He has $5,000 of interest and dividend income, and he pays health and dental insurance premiums of $12,000 for the year, for which he gets an adjustment to income of $10,000 for the self-employed health insurance. So remember, you can only take as much as you have income. So he had $10,000 from his business. He can only deduct $10,000 of those premiums for the self-employed health insurance deduction. He does have other out-of-pocket medical costs of $5,000. So what happens here? Well, John can treat $2,000 of those insurance premiums, the part that he could not deduct as a self-employed health insurance deduction. He can treat those as an itemized deduction. And of course, the $5,000 of out-of-pocket expenses for a total of $7,000. However, he's got this 7.5% of AGI floor. So 7.5% of his adjusted gross income is $2,250. So his deductible medical expenses are the $7,000 minus that $2,250, which equals $4,750. Moving on to our next category, which is taxes that are paid. Most of the taxes that will be deductible on the return are state and local taxes, also referred to as SALT. So you'll hear that phrase a lot. So you want to remember that SALT means state and local taxes. So first of all, state and local income taxes are deductible. This includes mandatory contributions to state unemployment, workers' compensation, and similar funds, and it includes taxes paid to a U.S. possession as well as to any of the states. As an alternative to deducting your state and local income tax, you can elect instead to deduct state and local sales tax. So some people may not pay much state and local income tax, and some states don't even have a state income tax, so they may not pay any state and local income tax. So they can elect instead to deduct their sales tax. And there's two ways they can do this. They can either keep all their receipts and deduct their actual sales tax paid, which would be a lot of work, but they can do it. Or they can use the tables and worksheets in the instructions to Schedule A. So if you go to Schedule A, you'll see this table and you'll look, and it depends what state you live in, how much money you make, and how many people are in your household. And based on all of that, it will give you a number that you can deduct without having to keep all of your receipts. So those are the two ways you can deduct your sales tax. But remember, it is one or the other, either your state and local income tax or the sales taxes, not both. The next type of state and local tax are real property taxes. They can be deducted. So the taxpayer may have their receipt for this, or they may get a 1098. So the 1098 we'll talk about next when we talk about interest expense. But if you pay mortgage interest, you will get a 1098 from the lender showing how much interest you paid. If you also paid in an escrow, so the escrow amount is to cover property taxes and homeowners insurance. So if you pay that in as part of your house payment, then the lender will put on the 1098 the amount that represents real property taxes. So you can take that number right from that 1098. If they don't have an escrow, then they're just going to have to tell you how much those taxes were or give you the receipt that shows how much they paid. If you sold your home, then the settlement statement may include taxes that were paid. So if you sell your home or any other type of property, you are responsible for the property taxes for the period of time that you owned the home. So that will be reflected on the settlement statement. But the person who buys the property, they're the ones who are actually going to pay the whole bill at the end of the year. But if you are the seller, they are going to subtract from the proceeds of the sale your share of the property taxes so you can deduct those. You cannot deduct any foreign property taxes, and you cannot deduct special assessments or assessments for items like trash service, lawn service, etc. So it is only actual taxes that you can deduct, not expenses for these other services. Some parts of the country also have personal property taxes, so taxes on your car, boats, airplanes, etc. If you pay those are also deductible as state and local taxes. So what are some taxes that you cannot deduct? Well, first of all, federal income and excise taxes are not deductible. Social Security, Medicare, federal unemployment, railroad retirement taxes, not deductible. Customs duties, federal estate and gift taxes, cannot deduct those. Certain state and local taxes, such as driver's license and marriage fees, taxes on gasoline, car inspections, special assessments, none of those things, even if they're called taxes, are not deductible. And then foreign, personal, or real property taxes are not deductible. As we'll talk about in a later video, you can deduct foreign income tax, though usually you won't because you will take a credit for that instead, but it is possible to deduct foreign income taxes. If you do deduct foreign income taxes, they are not part of the state and local tax limitation, which is what we'll talk about next. So there is a limit on the amount of state and local taxes that you can deduct. But that limit drastically increased for 2025. So previously, the limit had been $10,000 per year. But as part of the OBBBA, they raised that amount to $40,000 for 2025. And then it's going to go up gradually each year with inflation. But for 2025, the number you need to remember is $40,000 or $20,000 if you are married filing separately. That limitation can be further reduced for higher income taxpayers. So you have to reduce that $40,000 limitation by 30% of modified adjusted gross income that exceeds $500,000. However, no matter how much money you make, the limitation will not be reduced below $10,000. So let's look at a couple of examples. Example 1. In 2025, Delilah has modified adjusted gross income of $550,000 and pays state and local taxes of $60,000. Her SALT deduction is initially limited to $40,000 and must be further reduced by 30% of the amount that her adjusted gross income exceeds $500,000. So you take the $550,000 that she has, Subtract the $500,000, that's $50,000, times 30% is $15,000. You subtract that $15,000 from the $40,000 limitation, so her final SALT deduction is $25,000. Example 2. In 2025, Eunice has adjusted gross income of $700,000 and state and local taxes of $70,000. Her $40,000 SALT deduction must be reduced by 30% of the amount that her AGI exceeds $500,000. So that's $700,000 minus $500,000. That's $200,000 times 30%, which is $60,000. So obviously her limitation is only $40,000. So if you subtract 60 from 40, you get a negative number. However, it cannot be reduced below $10,000. Therefore, her final SALT deduction is $10,000. Our next category of itemized deductions is interest that is paid, and we'll start with home mortgage interest. A mortgage is any loan secured by your main home or second home, regardless of how the loan is labeled. It includes first and second mortgages, home equity loans, and refinanced mortgages. So first of all, it has to be secured by your main home or a second home. Can't do more than 2 homes. And secured by means that the property is collateral for the loan. When we say a home, that can be a regular house. It could also be a condominium, a cooperative, a mobile home, a boat, or a similar property. But no matter what it is, it must provide basic living accommodations, including sleeping space, toilet, and cooking facilities. So you hear about people living on their boat. Well, as long as it meets these requirements, you can deduct the interest on the loan for that boat. Also, notice that we did say home equity loans qualify, and that is true for 2025. That is not going to be true going forward, 2026 and future years. But for 2025, home equity loans do still qualify as long as they meet all of the criteria. So as we said, you can deduct the interest on up to 2 homes, your main home and one other. You can change that second home year to year. So if you've got 3 or more homes, you can take the interest on one home one year and another home the other year. It is up to you. You will want to look for that Form 1098 that reports the mortgage interest. Also look at the closing statement when buying or building a home. And note that mortgage insurance premium, sometimes called MIP, is not deductible in 2025. Again, that's going to change starting in 2026. They will be deductible, but for 2025, MIP is not deductible. Limits on mortgage interest. So loan proceeds must be used to buy, build, or substantially improve your home. If the proceeds were used for anything else, they are not deductible as home mortgage interest. And again, interest on home equity loans also counts as long as it meets this criteria. So if you took out that home equity loan in order to substantially improve your house, you can deduct the interest on it as mortgage interest. If you took out that home equity loan in order to pay off another loan, like we talked about in a previous video, that would not count. Or if you took that money out to go on vacation or to buy a car, it does not count. It's only if you used it to improve your home. If you did use the proceeds for business or investment purposes, then those amounts are not deductible as home mortgage interest. However, that interest may still be deductible as business or investment expense. And if you refinance a loan, as long as that original loan was used to buy, build, or substantially improve your home, then the new loan does still qualify for this interest deduction. There are also dollar limits on the amount of the mortgage that qualifies for the interest deduction. For loans taken out before December 15th of 2017, you can deduct interest on up to $1 million of that debt. If it was after December 15th of 2017, you can only deduct interest on up to $750,000 of debt. So remember the December 15, 2017 cutoff, $1 million before, $750,000 after. When you are determining the $1 million or the $750,000, you can elect to treat a mortgage as not being secured by your home and therefore not qualifying as home mortgage interest deduction if you want to. So let's say, for example, you take out a mortgage on your home to start a business. You can deduct the interest on that as a business expense. So what you can do is you can say, okay, I'm going to treat that as if it were not a mortgage, as if it were not mortgage expense. So then the amount of that loan will not play into this $1 million or $750,000 limit. You can treat it separately. Points. The general rule is that loan points are not deductible in the year that they were paid. Instead, they are deducted ratably over the term of the loan. So sometimes when you are buying a house, you will pay loan points. It's usually 1% of the loan. So if you're taking out a $200,000 mortgage, 1 point would be $2,000. That's a point. So what this is saying is the general rule is you cannot deduct those in the year that they were paid. Instead, you have to deduct them over the life of the loan. So if it's a 30-year loan, you have to deduct 1/30th each year. However, if you meet certain criteria, you can deduct those all in the year that they were paid. And most of the time, you're going to meet that criteria. So there's criteria about that the mortgage itself has to qualify. The points are based on a percentage of the loan, which, as I described, they usually are. They have to be reasonable, and your cash out of pocket at closing has to be at least as much as the amount of those points. So as long as you meet all of those criteria, you can deduct those in the year paid. So general rule is you have to deduct them ratably over the course of the loan. However, in real life, most of the time they will be deductible in the year paid. And then there are similar rules if your loan is not to buy or build the home, but to improve the home. Usually you can deduct those points as well. The next type of interest is investment interest. So investment interest is interest on a loan that is used to generate taxable investment income. So it does not include interest allocable to passive activities or to tax-exempt securities. So if you borrow money in order to invest, let's say, in the stock market, you can deduct that interest. Or if you borrow to invest, let's say it's a private company, it's not the stock market. You've got a friend who's starting a business and you really believe in the business and you borrow money in order to invest in that. You can deduct that as investment interest. If you have a margin account with your broker, so these are fairly common, your broker will loan you money on a short-term basis in order to buy stocks and bonds, and then they will charge you interest on that. That interest is deductible as investment interest. Our next category of itemized deductions are charitable contributions. You will definitely get questions on the exam about charitable contributions, and there are lots of rules, so you're going to want to pay attention here. So you can deduct gifts to qualified charitable organizations. What does that mean? It is an organization that is for religious, charitable, educational, scientific, or literary purposes, or that works to prevent cruelty to children or animals. The organization must have applied for and received tax-exempt status from the IRS or have other not-for-profit status, such as a governmental entity. So you've probably heard organizations say we are a 501c3 organization. So this is what they're talking about. They go to the IRS, they apply for status as a 501c3 organization. If they get that, then contributions to that organization are tax deductible. We will learn more about that and how that works in part 2. There are certain organizations that do not have to go to the IRS and get that approval, such as governmental entities. Even churches do not have to go to the IRS and ask for 501c3 status, but contributions to them are still deductible. So these are going to be your typical charities that you would think of donating to. They are going to qualify. The contributions can be in cash, property, or even out-of-pocket expenses that you pay while doing volunteer work. So let's talk about this cash and property because this is going to come up a lot and you want to understand what it means. When we talk about cash contributions, we're using the word cash to just mean money in general. We're distinguishing it from other types of property. So it doesn't have to be actual cash, actual greenbacks that you are giving to the charity. It could be a check that you wrote. It could be an electronic funds transfer. It could even be a credit card payment. If you donate to a charity on a credit card, that counts as a cash contribution. We just mean that you're not giving other types of property. So if you are donating, for instance, household goods, your old clothing, to your local charity, that is a property contribution, not a cash contribution. If you are giving some stocks that you own to a charity, that is a property contribution. So we're just distinguishing between other types of property and money. Then we also have these out of pocket expenses. So if you volunteer for one of these organizations and you have unreimbursed expenses, you can deduct those as a charitable contribution. For mileage, you are limited to 14 cents per mile, which is kind of a joke these days. So, as a comparison, if you have business mileage, you can deduct 70 cents per mile, but charitable mileage is only 14 cents per mile. That's because when Congress wrote this law, they wrote 14 cents per mile into the law, and it was a long time ago, and they put no provision in there for inflation or for discretion on the part of the IRS or anything else. So, for business mileage, for example, the IRS can determine each year, based on gas prices, based on inflation, they can determine how much the business mileage deduction is. They do not have that flexibility for charitable mileage because it says right in the law that it is 14 cents per mile. So we are stuck with that unless and until Congress changes it someday. But for the exam, you will want to remember 14 cents per mile. And then in order to deduct charitable contributions, you do have to itemize deductions. There is no above the line charitable contribution for 2025. There will be starting in 2026, but for this year's exam, you must itemize in order to deduct charitable contributions. So, what are non deductible contributions? First of all, if you receive a tax credit for a contribution, you cannot also deduct it. Any amounts paid to a college or university for the right to purchase tickets to athletic events, not a charitable contribution. Travel expenses while away from home, unless there was no significant element of personal pleasure or vacation. So remember, we said if you volunteer for an eligible organization, you can deduct your related expenses. Well, if those expenses are for travel while away from home, you cannot deduct them unless there was no significant element of personal pleasure or vacation. So, what happens is you have people who serve on the board of directors of a charitable organization. So, they are a volunteer director of that organization. Sometimes those organizations will have board of director meetings in some exotic location, and everybody goes there for their meeting and then they enjoy themselves while they are in that exotic location. You cannot deduct your expenses for that because that is essentially a vacation. Contrast that with someone who works for a disaster relief organization such as the Red Cross. And let's say there's a major hurricane in Hawaii and they travel to Hawaii to provide aid to the people affected by the hurricane, and they've got unreimbursed expenses. Those they can deduct because they didn't go to Hawaii to enjoy the beach. They went there to help with the tragedy, so they can deduct those. The next type of contributions that are not deductible as charitable contributions are political contributions, cannot be deducted. Dues, fees, or bills paid to country clubs, lodges, fraternal orders, etc., not deductible. The cost of raffle, bingo, or lottery tickets are not deductible, though they may be included with gambling losses that we'll talk about later. The value of your time or services is not deductible. So you will sometimes have clients who will say, hey, look, in my business, in my profession, I charge, let's say, $100 per hour. and I did that same work for this charitable organization, and I put in 10 hours during the year, can I deduct $1,000 as a charitable contribution? And the answer is no, you cannot. You cannot get a deduction for the value of your time or your services. You can also not get a deduction for the value of blood that is given, for the transfer of a future interest in tangible personal property. So if you say, I'm going to let you have this in the future, you cannot get a deduction for it now. You cannot get a deduction for gifts to individuals or to groups that are operated for personal benefit. So we have a lot these days of these GoFundMe and other types of fundraisers for people who have had some sort of problem in their life. That's great if you want to give to those, but it is not deductible as a charitable contribution. And then gifts to foreign organizations are generally not deductible, with some exceptions for some Canadian, Israeli, and Mexican charities. More non-deductible contributions, gifts to organizations engaged in political activities that are of direct financial interest to your trade or business. Cannot deduct those. Gifts to lobbying groups, you cannot deduct. Gifts to civic leagues, social and sports clubs, labor unions, and chambers of commerce, not charitable contributions. And the value for any benefits received in connection with a contribution cannot deduct. We'll talk more about that on the next slide. And then the cost of tuition is not a charitable contribution, though you may be eligible for an education credit. If you do make a gift and receive something in return, such as food, entertainment, or merchandise, you can only deduct the amount that is greater than the value of the benefit received. So if you go to a $100 per plate charitable dinner and the dinner is worth $40, then you can only deduct $60. That's what this is saying. Now, this rule does not apply to certain membership benefits that are received for an annual payment of $75 or less, or to items of token benefit. For gifts of $250 or more, whether or not you receive something in exchange, you must have a contemporaneous written acknowledgement from the organization showing what you donated and whether or not you received anything in return. So if you give $250 or more all at one time, you need to get a receipt from the organization showing how much you gave and whether or not you got something in return. If you give multiple gifts that add up to $250 or more, this rule does not apply. So maybe you go to church every week and you put $20 in the collection plate. Obviously, over time, that's going to add up to more than $250 per year, but you do not have to get a receipt for that. Charitable contribution limits. So you will want to know these percentages, the 60, 50, 30 rule. Cash contributions are limited to 60% of adjusted gross income. Non-cash contributions are limited to 50% of AGI minus your cash contributions. And gifts of capital gain property cannot exceed 30% of adjusted gross income. So if you are giving, for instance, some stocks, the amount of your deduction cannot exceed 30% of your adjusted gross income. If you are giving cash, the amount of your deduction cannot exceed 60% of your adjusted gross income. And for any non-cash contributions, those are limited to 50% of your AGI minus your cash contributions. You will want to remember those. There are other limitations in addition to these. So if you want more information, you should see publication 526, but these are the main ones you want to remember for the exam. You also want to know for the exam that if you contribute amounts that exceed these limitations, you can carry those over to future years for up to 5 years. So remember that excess charitable contributions can be carried over for up to 5 years. Contributions of property. So now we're not talking about cash contributions. We're talking about all the other contributions. Contributions of property under $250 in total to one organization, you should try to get a written receipt from the charity with the description of the property, the date, the name of the organization, etc. However, if it's under $250 and it's not practical to get a receipt, so maybe you're dropping something off at night at a drop-off site, then you can use your own records, but you do have to keep detailed records about what you gave, how much it was worth, how you determined how much it was worth. So you can avoid having to do that if you get a receipt from the charity. But if you don't get a receipt from the charity, then you need to keep those detailed records. For contributions of property between $250 and $500, you do need to get a written receipt. You cannot rely just on your own records. For contributions of property between $500 and $5,000, then in addition to getting that receipt, you have to file a form, Form 8283, with your tax return. That form does require you to provide even more information, a more detailed description, when you acquired the property, how much you paid for it, what condition it was in, etc. So you have to fill out the 8283 and get a receipt if the property is between $500 and $5,000. If the contribution of property is for more than $5,000, then not only do you have to file the Form 8283, you have to get a written appraisal from a qualified appraiser. If that property is a vehicle, there are different rules that apply that we will talk about soon. But for other types of property, if it is over $5,000, you have to get that written appraisal. There are special rules for certain types of property. So first of all, clothing and household items. In order to deduct those, they must be in good, used condition or better, unless you have an appraisal for $500 or more. So if you've got some antique household item that's worth $500 or more, then it does not have to be in good, used condition. But for most things that you're donating, so you're donating your old clothes, things from around your house, in order to deduct those, they have to be in good, used condition. So they don't want people deducting their trash. So just because you happen to give your old ratty clothes to a charity does not mean that you can deduct them. They have to be in good, used condition or better. And when we talk about household items, that includes furniture and furnishings, electronics, appliances, linens, and other such similar items. But it does not include food, paintings, antiques, and other objects of art, jewelry, and gems or collections. So again, if you are donating some piece of art, it does not have to be in good, used condition or better. It's just the normal household items that you might be donating that rule applies to. Cars, boats, and airplanes. So if you are giving one of these and the value is more than $500, then you can deduct the smaller of the gross proceeds of the sale of the vehicle by the organization or the vehicle's fair market value on the date of the contribution. So if you're donating a car, for example, oftentimes the charity isn't going to actually use the car. They're going to sell it and then use the proceeds. And then they will report to you on a 1098-C the amount that they received. So that is the amount that you can deduct. If the value is worth less than $500, then you can deduct the smaller of $500 or the actual value of that vehicle on the date of the contribution. And of course, if it's worth more than $250, you still do need a receipt from the organization. Taxidermy property, the deduction is limited to your basis in that property or its fair market value, whichever is less. So whatever it cost you to stuff that animal, that's your basis. So you're going to take the lesser of that or its fair market value. And for any property subject to a debt, you have to reduce the amount of the donation by the amount of debt that was assumed by the organization. So let's say you are donating, for example, a building that has a mortgage on it, and the charity is going to assume the mortgage. They're going to take over the mortgage for you. You have to reduce the amount of the contribution by the amount of the mortgage that they assumed. And then if you take any type of interest deduction for amounts paid after you donated the property, then you have to reduce the amount of the charitable contribution by the amount of the interest deduction. That's what these last 2 points are saying here. Determining the fair market value. So in general, fair market value is the same that we discussed in a previous video. It's the price at which property would change hands between a willing buyer and a willing seller, neither having to buy or sell, and both having reasonable knowledge of all the relevant facts. Remember, that is fair market value. For used clothing and personal items, the fair market value is usually going to be far less than the price you paid. You claim the amount that buyers actually pay in used clothing stores such as thrift shops. So if you've got those $300 tennis shoes that you've been wearing for the last 2 years, you are not going to be able to deduct $300. You have to see how much of those same type of tennis shoes selling for in thrift shops. That is the amount you can deduct. If the fair market value of a donated item is less than your basis, then you can deduct only the fair market value. You get no deduction for a loss on the donation. So let's say you've got some stocks that you bought through your broker, publicly traded stocks. They are worth less than you paid for them. You can donate those to the charity, but the amount of your donation is only going to be the fair market value. You cannot deduct your basis, since your basis is higher than the fair market value. On the other hand, if the fair market value is higher than your basis, then if it's capital gains property, you can actually deduct the fair market value and you don't have to recognize any gain. So let's say you have those stocks, but they're worth more than you paid for them. If you want to make a contribution to a charity, what you do not want to do is sell those stocks and then donate the cash to the charity. Because if you do that, you're going to have to pay capital gains tax on the sale of those stocks. What you should do instead is just give the stocks to the charity. You get a deduction for the full fair market value of those stocks, and you do not have to pay any capital gains tax on the difference. The charity, of course, is not taxable, so they can sell the stocks, don't have to pay tax. So if you have a client who wants to make a charitable contribution, this is a good way to do it. Give the charity appreciated property that you normally would have to pay capital gains tax on. It's good for the charity and it is good for the taxpayer as well. If it is not capital gains property, so it's ordinary income property, then you deduct only your basis. So for example, let's say you have a business and you're going to donate some of your inventory to a charity. You can only deduct your basis, even if the fair market value is higher. Of course, if the fair market value is lower, then you've got this rule up here. You can only deduct the fair market value. But if the fair market value is higher, if it is ordinary income property, you can only deduct your basis. Our next category of itemized deductions are casualty and theft losses. So personal casualty and theft losses are generally not deductible unless they occur in a federally declared disaster area. So remember that. The general rule is casualty loss is not deductible unless it is in a federally declared disaster area. There are 3 types of federally declared disaster areas, or 3 types of deductible casualty losses. There are what are called federal casualty losses, disaster losses, and qualified disaster losses. So we will talk about each of those 3. But first, we have to understand what exactly is a casualty and what is a theft. So this is the definition of a casualty. It is the damage, destruction, or loss of property resulting from an identifiable event that is sudden, unexpected, or unusual. So sudden means it's swift and it's not gradual or progressive. Unexpected means that it is not ordinarily anticipated or intended. And unusual means that it is not a day-to-day occurrence or one that would be typical of an activity in which you are engaged. So it's something that happens quite unexpectedly and suddenly. That is a casualty. What is a theft? It is the taking and removing of money or property with the intent to deprive the owner of it. The taking must be illegal under the law, and it must have been done with criminal intent, though you do not have to show that there was a conviction in order to count it as a theft. Theft does include the taking of money or property by any of the following: blackmail, burglary, embezzlement, extortion, kidnapping, larceny, robbery. Anything like that does count as theft. The taking of money or property through fraud or misrepresentation is also theft as long as it is illegal. So what are some examples of losses you cannot deduct? You cannot deduct the value of money or property that is misplaced or lost. You cannot deduct the breakage of china, glassware, furniture, etc. So if it was during an earthquake or something in a disaster area, yes, you could deduct it, but just normal breakage you cannot deduct. You cannot deduct progressive damage to property caused by termites, moths, and other insects or disease. And you cannot deduct the decline in the market value of the stock because of some illegal happenings at the company that caused the market value of that stock to decline. That is not a casualty or a theft. So now let's start talking about those three different types or categories of casualty losses. First are federal casualty losses. A federal casualty loss is an individual's casualty or theft loss of personal use property that is attributable to a federally declared disaster area. The casualty loss must occur in a state receiving a federal disaster declaration. If you suffered a federal casualty loss, you are eligible to claim a casualty loss deduction. But if you did suffer a casualty or theft loss that is not in a federally declared disaster area, then you cannot deduct it. The only exception is you can use it to offset any casualty gains. So sometimes you may actually have a gain on a casualty. The insurance proceeds that you receive exceed your basis in the property. That would be a gain. Well, if you have a gain, you can use any losses to offset that gain, even if the loss did not occur in a federal disaster area. You can do that. But you cannot have a net loss due to a casualty or theft that did not occur in a federal disaster area. For a federal casualty loss, in order to deduct it, first you're going to compute the amount of the loss. The amount of the loss is you're going to take the lesser of the basis in the property or the reduction in the fair market value due to the disaster, and you're going to subtract any insurance or other reimbursement that was received. So usually if your property was a total loss, you're just going to compare your basis in that property to the amount of insurance proceeds that you got. The difference is going to be your gain or loss. We're assuming here that it is a loss. So you bought a car for $40,000. Tornado comes through, destroys that car. It's declared a federal disaster area. Insurance company gives you $10,000 for that car. You have a $30,000 disaster loss. Now, there could be cases where the entire property is not destroyed. So maybe you have a building and it's not completely destroyed, but it does a lot of damage. Well, in that case, you're going to say, how much damage was done? How much was the fair market value of this building reduced by this disaster? You're going to compare that reduction in fair market value to the insurance that was received. So that's the way that works. Once you have determined the amount of the loss, you subtract $100 from it. And that applies once per event, not per piece of property. After you subtract the $100, you are then going to subtract 10% of your adjusted gross income. So we have a 10% of AGI floor on the deduction. So you take the amount of the loss, subtract $100. The only amount that is deductible is the amount that exceeds 10% of your adjusted gross income. And then generally you are going to claim that loss in the year of the casualty. So whenever that event occurred, that year is when you will deduct that loss. Then we have a chart, just shows you more specifics on how you apply this $100 rule and the 10% rule. Not going to read that to you. That comes right out of publication 547. So you can read that at your leisure, but it's just giving you a little bit more information about how those rules work. So let's do an example. Fred and Elizabeth suffer a $20,000 loss when their car is destroyed in a hurricane, which is declared a federal disaster. They have liability-only insurance on the car and so do not get any type of insurance settlement. Their adjusted gross income is $50,000. How much casualty loss are they entitled to deduct as an itemized deduction? Well, first we have to deduct $100 from the loss, making it $19,900. Then we subtract 10% of AGI. So that's $50,000 times 10% is $5,000. So their deductible loss is $19,900 minus $5,000, which equals $14,900. And for a federal casualty loss, they can only take that deduction if they itemize deductions. Our next category of losses is a disaster loss. So a disaster loss is one that is attributable to a federally declared disaster, and that occurs in an area eligible for assistance pursuant to the presidential declaration. So the disaster loss must occur in a county eligible for public or individual assistance. So the difference between a federal casualty loss and a disaster loss is that with a disaster loss, not only are they declaring it a disaster area, they are also offering assistance to the people in that area. If you have a disaster loss, then you are eligible to claim a disaster loss deduction, and you can elect to claim the loss in the preceding year if you want to. We'll talk more about that on the next screen. If you are working with clients and you're trying to figure out, does this disaster count as a disaster loss or a federal casualty loss, etc., you can go to this website, fema.gov/disaster, to get more information. Let's talk a little bit more about these disaster losses. For a disaster loss, the deduction rules are the same as for a federal casualty loss. So you subtract $100, and then only the amount in excess of 10% of AGI is deductible. The difference here is that you can take the loss either in the year of loss or the prior year. So if you have a casualty anytime during the year, but let's say it was early in the year, let's say it happened in February of 2026. If you have a federal casualty loss, you can only deduct that in general in 2026. If it is a disaster loss, so it meets this criteria of having assistance available, then you can choose to deduct it on your 2025 tax return. So you may not have filed your 2025 tax return. So rather than having to wait until next year to deduct it, you can actually deduct it on your 2025 return. Even if you already filed your 2025 return, you can amend it in order to take the disaster loss for 2025. But that's the only difference between a disaster loss and a federal casualty loss. Otherwise, the amount of the loss is computed exactly the same way. And then our final category of disaster losses is a qualified disaster loss. So a qualified disaster loss includes an individual's casualty and theft loss of personal use property that is attributable to any of the following: a major disaster declared by the president under Section 401 of the Stafford Act in 2016, or any of these particular disasters: Hurricane and Tropical Storm Harvey, Hurricane Irma, Hurricane Maria, the California wildfires in 2017 and 2018, and then any major disaster that was declared by the president under the Stafford Act that occurs between the dates shown on your screen. And then very importantly, a major disaster that was declared by the president during this period, January 1st, 2020 and September 2nd of 2025. Also, the disaster must have an incident period that began on or after December 28th, 2019 and on or before July 4th of 2025 and must have ended no later than August 3rd of 2025. So what do we mean here? Well, this was actually a big change in the law, and it helps a lot of people. It used to be, in order to have a qualified disaster loss, it had to be a disaster declared under this Section 401 of the Stafford Act, which has very specific requirements. A few years ago, the law was changed to say it does not have to be declared specifically under Section 401 of the Stafford Act. It is any major disaster as declared by the president. So this allows a lot more disasters to be included as a qualified disaster loss. Now, what's with all these dates? The main one you want to know is that it did have to occur on or before July 4th of 2025. It must have ended no later than August 3rd of 2025. Every couple of years, Congress updates these dates. So we should expect some legislation in the future that will extend these dates even further. But when they passed the OBBBA, they extended the dates to the date of enactment of the law, which was July 4th of 2025. So that is the key date. So what's so special about a qualified disaster loss? Well, for a qualified disaster loss, you do not have the regular $100 10% of AGI rule. Instead, you subtract $500 from the amount of the loss rather than $100. However, it is not subject to that 10% of AGI floor or any other type of limitation. So you take the amount of the loss, you subtract $500, and then you can take that full amount as a deduction. You can also take the loss for the preceding year if you want to, and you do not have to itemize in order to take this deduction. So this is the one we talked about back when we talked about the standard deduction. We said you can take the amount of the loss, subtract $500, add it to your standard deduction. That is only if it fits into this qualified disaster loss category. So while all disasters, of course, are terrible, from a tax standpoint, we would prefer that it be a qualified disaster loss because that gives the taxpayer the greater deduction. So let's do an example. We'll talk about Fred and Elizabeth again. They got their same $20,000 loss from their car, but this time it qualifies as a qualified disaster loss. So they have their $20,000 loss. Their AGI is $50,000. How much casualty loss are they allowed to take as an itemized deduction? Well, the answer is $19,500. Their loss was $20,000. Subtract $500 from it. That's the only limitation. So they can deduct $19,500 as an itemized deduction. And of course, even if they don't itemize, they could instead add that $19,500 to their standard deduction. So as we mentioned before, you don't always have a loss when there is a disaster. You could actually have a gain. So if you have a gain that is realized from a disaster on your main home, then you may not have to pay tax on all or part of that gain. And this applies, by the way, to renters as well as homeowners. Any gain on reimbursement for unscheduled personal property does not have to be recognized. So what does unscheduled mean? Most of the property that you have is unscheduled, which means you have not specifically listed it on your homeowner's insurance policy as being scheduled property. So your normal furniture, clothing, etc., is going to be unscheduled property. If you have some very expensive items, like you've got some expensive items of jewelry, or you have an expensive collection of some sort, you may actually schedule that on your homeowner's insurance. You tell the insurance company, look, I have this tennis bracelet, it's worth this amount of money. I've got this stamp collection, it's worth this amount of money. Those would be scheduled items. Well, any reimbursement on unscheduled items, so that's your normal household goods and personal property, there is no gain. So it doesn't matter what your basis in those things is. They reimburse you for the loss of your couch and your clothing and your other furniture and personal items. You don't have to figure out how much was my basis, how much insurance did I get, and do I have a gain on that? You do not have to pay any tax on those amounts. Also, if this is your home, you may qualify for that $250,000 or $500,000 exclusion for gain on sale. So it is a casualty, not technically a sale, but you can use those same rules. So as long as you qualify, you can exclude the gain on the reimbursement that you get from the insurance company. And that applies, by the way, even if it's not in a disaster area. So if your house just burns down, not in a disaster area, if you meet the qualifications for exclusion, you can exclude those amounts. If you'll remember in video 3, we talked a little bit about this. If you have a casualty loss, remember if you replace that property within a certain amount of time, you can postpone the gain. That normal period of time is 2 years. So as long as you replace the property within 2 years, you don't have to pay tax on the gain. But remember, there was that exception that if it's your main home and it's in a disaster area, then that is 4 years instead of 2 years for the replacement property. But in any case, when you're looking at that replacement, any additional insurance proceeds that you receive for the home or its contents are treated as received for a single item of property. And any replacement property that you purchase to replace lost items are treated as a single replacement property. Therefore, you can choose to recognize gain only to the extent that the insurance proceeds exceed the total replacement costs. And we're going to look at an example here so you can see what we mean. George and Carla lost their home and all of its contents in a tornado in a federally declared disaster area in 2025. They received insurance proceeds of $200,000 for the home, $25,000 for unscheduled personal property, $5,000 for jewelry, and $10,000 for a stamp collection. And the jewelry and the stamp collection are scheduled property. Well, they do not have to pay any tax on the $25,000. That's for unscheduled personal property, not taxable. What they're allowed to do is add the value of the scheduled property. So they've got $15,000 of scheduled property. They can add that to the $200,000 that they received for the home. So as long as they spend $215,000 or more on a new home before 2030, they do not have to recognize any gain. That gain is postponed until they sell their new house. So the main point here is that we are going to lump together the house and any scheduled property and treat it as if it were one. So when we're looking at that replacement period, treat it all as if it were one piece of property. Now we'll move on to our last category of itemized deductions, which is other itemized deductions. And you can see them listed on the screen here. I'm not going to read this to you, but we are going to go over most of these. We're going to start with a couple of them that are still related to casualty and theft losses, but they fit into the other itemized deduction category because they don't have any of the normal casualty loss rules. In other words, they do not have to be in a federally declared disaster area. You don't subtract $100 and 10% of your AGI and all of that. So first of all, casualty and theft losses on income producing property. So when we talked about the other casualty and theft losses, we were talking about personal use property. If instead we're talking about income producing property, such as rental property, then the normal casualty loss rules do not apply. It does not have to be in a disaster area. If you own a rental home and it burns down, not in a disaster area, you can take that as a loss. And you do not have to reduce it by $100 or 10% of your AGI. So you can deduct the full amount of the loss, which is based on the adjusted basis of the property, less any salvage value, less any insurance or other reimbursement that is received. So if your basis in that home is $200,000 and you only get $180,000 from the insurance company, you can deduct a $20,000 casualty loss. Next are losses from a Ponzi scheme. So this is a lot like a theft, but it is a specific type of theft called a Ponzi scheme. So losses from Ponzi schemes are deductible as theft losses of income producing property. And so you do not have to be in a disaster area and you do not have the $100 10% of AGI rule. There are more rules about exactly how this works. You can check out Form 4684 to see that. For the exam, just know that losses from a Ponzi scheme can be deductible as an other itemized deduction. Similarly, losses of income producing property for victims of other types of scams that are not Ponzi schemes may also be deductible. Again, see Form 4684 to know the details, but for the exam, just know that it is on the list. Next is the amortizable premium on taxable bonds. So in general, if the amount that you pay for a bond is greater than its stated principal amount, that excess is called a bond premium, and you can amortize that premium. You don't need to know the details of this, just know that it is on the list. Fines or penalties, in general, fines or penalties are not deductible. So if you get a traffic ticket, it's not deductible. If you get a fine for some crime that you committed, that is not deductible. There are some exceptions you can see here on the screen. But again, the main thing to know for the exam is that fines and penalties are generally not deductible. Gambling losses, we talked about the flip side of this when we talked about income. So generally, you must report the full amount of your gambling winnings for the year on Schedule 1. You can deduct your gambling losses on Schedule A as an itemized deduction, but only up to the amount of your winnings. You cannot simply reduce your winnings by your losses and report the difference. So if you hit a slot machine for a $10,000 win, you can't say, well, but I put $8,000 into it before I won the $10,000, so I'll just report $2,000. That is not the way it works. You have to report the full $10,000 as income, and then if you itemize deductions, you can deduct the $8,000 as an itemized deduction. And you have to keep records. So you can't just say you put $8,000 in. You have to keep records as you're going along, some sort of gambling diary. You can use an app on your phone, something like that, that tracks when you gambled, where you gambled, how much you gambled, etc. If you are a professional gambler, then you can report using Schedule C, and you can deduct not only your losses, but also your expenses, so your travel expenses, etc. But again, only up to the amount of your winnings. So even if you're a professional gambler, you cannot show a loss for the year. You can only deduct your losses and expenses up to the amount of your gambling winnings. Home office deduction. We are going to cover this in more depth in part 2, but it is possible you could get a question about this in part 1, so we want to understand at least the basics. If you use part of your home regularly and exclusively for business, then you can take a home office deduction. So most often this is going to be a separate room that you use as your office. But it does have to be used exclusively for business with a couple of exceptions. If you have an area that is used to store inventory, it does not have to be an area that is only used for the business. And also, if you run a qualified licensed daycare facility in your home, well, it's understood that the kids are going to be running around your family room and your kitchen, et cetera, and those are not going to be used only for business. So there is an exception for that. But other than that, you do have to use that space exclusively for business. It must be your principal place of business or the only place where administrative or management activities can be performed. So maybe you're a doctor who actually does your work with patients at a hospital, for example, but you're not an employee of the hospital and they do not provide you a space to do all your paperwork. You do that at home. Well, you can count that area as your home office and deduct it. This cannot be, though, as an employee. You must be in business for yourself. When you are computing the amount of the deduction, there are two methods you can use, the simplified method and the regular method. So first of all, the simplified method, this is nice. We didn't used to have this. You can take as a deduction $5 per square foot for the area used regularly and exclusively for business, but it's a maximum of 300 feet, which means it's a maximum of $1,500. So if you've got a room that you use and it's 200 feet, you can take 200 feet times $5 is $1,000 as your home office deduction. You don't have to then prove how much you paid for utilities and for mortgage interest and all of that. You can just take the number of square feet times $5 and you are done. Or you can use the regular method. With the regular method, the deductions are based on the percentage of the home that is devoted to business. So usually that's going to be based on the square feet used for business divided by the total square feet of living space. So if you use 200 square feet and your total living space is 2,000 square feet, then you would take 10% of the expenses as your home office deduction. So you would deduct that percentage of your mortgage interest, your homeowner's insurance, your utilities, repairs, maintenance, depreciation, and rent. So those are the two methods. For most taxpayers, it's going to be easiest just to take the simplified method, but you can run it both ways and see which one gives the larger deduction and use that one. For the exam, remember this: maximum 300 feet and $1,500. Repayments under claim of right. If you included in income $3,000 or more in a previous year because you thought you had an unrestricted right to that income, and then you have to end up paying it back, you can take a deduction for the amount paid back. So let's say, for example, you worked for a company as a sales rep and you got advanced commissions of $5,000 in 2024. Then you ended up leaving that job, let's say in early 2025, and you had to pay back that $5,000. Well, you received the $5,000 in 2024, so you're going to include it in your income because you're a cash basis taxpayer, and you thought you were going to be keeping that money, but now you had to pay it back. So in 2025, you can take that $5,000 as an itemized deduction. So what types of expenses are not deductible? Well, here are some examples. First of all, charitable contributions for non-itemizers. Again, for 2025, if you don't itemize, you cannot deduct any charitable contributions. Those mortgage insurance premiums are not deductible in 2025. And then miscellaneous itemized deductions subject to the 2% of AGI floor are no longer deductible. So prior to 2018, there were these miscellaneous deductions, and you could add all of them up. And to the extent that they exceeded 2% of your adjusted gross income, you could deduct them. But starting in 2018, those were no longer deductible. That was a temporary provision that was supposed to last through 2025. But what Congress did is they made it permanent. So those 2% of AGI floored items are no longer going to be deductible in 2025 or even in 2026 and future years. So that does it for our itemized deductions. Now let's talk about the new below the line deductions that were added by the OBBBA and are effective in 2025. The four deductions that were added are the qualified tips deduction, the qualified overtime deduction, the new car loan interest deduction, and the enhanced deduction for seniors. Again, these are below the line because they are after we compute adjusted gross income. However, they are not tied to whether or not we take the standard deduction or itemized deduction. They are separate from that. So whether you itemize or take the standard deduction, if you qualify for any of these, you can take these deductions. How do you report them? Well, you put them here on Schedule 1A. So this is a new schedule for 2025. So let's have a closer look. So you can see here at the top, first thing you're going to do is compute your modified adjusted gross income because that is going to be important. So throughout this course, you've already heard me referring to modified adjusted gross income. For most taxpayers, it is the same thing as adjusted gross income. What we're doing when we take modified adjusted gross income is usually what that means is we are adding back any exclusions that we had for income from Puerto Rico or for foreign source income from Form 2555. So when we say modified adjusted gross income, we have to add those numbers back to our adjusted gross income. So again, most people don't have those things. And so modified adjusted gross income is the same thing as adjusted gross income. But in any case, that's where you compute it. Then we're going to come down here and we're going to do the no tax on tips, no tax on overtime. Then we're going to go to the next page and we're going to see the no tax on car loan interest and finally the enhanced deduction for seniors. Then we're going to add up all of those deductions and those will be carried over to the Form 1040. So let's start with the qualified tips deduction. So this is new for 2025. For right now, it is set to expire after 2028. We'll have to see what future Congresses do. They may extend it, but for now it is for 2025 through 2028.
and it is a deduction for qualified tips that are received and reported on a statement, such as a W-2 or a 1099, up to a maximum of $25,000 per year. And that $25,000 is for all filing statuses, except married filing separately, in which case you cannot take the deduction. But for all of the other filing statuses, it is $25,000 per year. Again, the taxpayer does not have to itemize in order to take this. And this deduction does phase out for higher income taxpayers. So to the extent your modified AGI exceeds $150,000 or $300,000 if you're married filing jointly, the deduction is going to be reduced by $100 for each $1,000 of AGI over that threshold. So, for example, if you're single and your AGI is $160,000, you are $10,000 over the threshold. So you have to reduce your tips deduction by $1,000 because it's $100 for each 1,000 that you're over. You're over by 10,000, so you're going to reduce it by 10 times 100 or $1,000. So if you were entitled to the full $25,000, you would only be able to deduct $24,000. If you are self-employed, the deduction cannot exceed your profit from the business. So the qualified tips deduction cannot cause you to, in effect, have a loss from your business. It can take you to zero, but not below zero. This is an income tax deduction only. You still do owe Social Security and Medicare tax, and you must have a Social Security number and have it on the tax return in order to take this deduction. There is this IRS notice. It covers both the qualified tips deduction and the qualified overtime deduction. So if you want more information, you can check that out. But let's talk a little bit more about the qualified tips deduction. What does qualified tips mean? It's cash tips received by an individual in an occupation which customarily and regularly receive tips on or before December 31st, 2024, as provided by the Secretary. So the IRS has published a list of professions that qualify for this deduction. So they looked at what are the types of professions that typically get tips, and they put that list together. Those are the occupations that qualify for the tips deduction. When we say cash tips, again, it doesn't have to actually be cash. It could be on a credit card. It could be a part of a tip sharing arrangement. The tips must be reported to you on a form. So it's included in your income. So it's on your W-2 or it's in a 1099, or you declared them on this 4137. Form 4137 is for employees who get tips that were not reported to their employer. They are supposed to report those on a Form 4137. You cannot take the tips deduction for any tips that were not reported to you on a W-2 or a 1099, or that you did not put on this Form 4137 as an employee who had unreported tips. In the future, your W-2 or 1099 will specifically identify the amount of tips that qualify. For 2025, since the law was passed halfway through the year, the IRS did not update the W-2 or 1099 forms. So they've got some special transition rules that the employers do not have to actually separately identify it on those forms, and that the taxpayer can use any reasonable method to determine the amount that is deductible. Again, look at that IRS notice 2025-69 for more details on how that works. I would not worry about that so much for the exam. The tips that are paid must be voluntary and the amount determined by the payor without negotiation or negative consequences for not paying. So in a lot of restaurants, if you've got a group of, say, 6 or more, they just automatically add on like an 18% gratuity. That does not count for this law because that is not voluntary. Has to be voluntary and the amount determined by the payor. Also, it cannot be in what is called a specified service, trade, or business, or SSTB. This is a qualified business income deduction concept that you will be learning here in a little bit in this video. But for now, just know that if you are in an SSTB and you get a tip, it does not qualify for the qualified tips deduction. And any tips deduction that you take has to be subtracted from your business income for purposes of the qualified business income deduction. So let's do an example. Sam and Diane are married and file jointly. Sam is a bartender and earns qualifying tips reported on his W-2 of $30,000, and Diane is a waitress and has qualifying tips of $35,000. Their adjusted gross income is $100,000. What is their tips deduction for 2025? So what do you think? They have a total of $65,000 of qualifying tips, $30,000 for Sam, $35,000 for Diane. What is their tips deduction? If you said $50,000, you are wrong. The amount of their tips deduction is $25,000. Remember, the deduction is a maximum of $25,000 for all filing statuses, except for married filing separately, in which case it's zero. So even though both Sam and Diane had more than $25,000 of qualifying tips, their maximum deduction as a married filing jointly couple is $25,000. Note that if they were not married, so if they were single and living together, they could each deduct $25,000. But because they're married, they can only deduct $25,000 in total. And if they had filed married filing separately, they could not have deducted anything. Our next new deduction is the qualified overtime deduction. Again, it's for 2025 through 2028. The maximum allowed deduction is $12,500 per year or $25,000 married filing jointly. So here you do get more if you are married filing jointly. It is for qualified overtime compensation paid to an individual that is required under Section 7 of the Fair Labor Standards Act, or FLSA, of 1938, that is in excess of their regular rate. So if you get time and a half, it is only the half portion that qualifies for the deduction. Again, you do not have to itemize. And again, it does phase out. These are the same amounts of phase out as for the tips deduction. So it's $150,000 or $300,000 if you are married filing jointly. And again, the deduction is reduced by $100 for each $1,000 of AGI over the threshold. Again, it is an income tax only deduction. You'll still pay Social Security and Medicare tax, and you do have to have a Social Security number. In the future, the employer must separate out the overtime on the W-2. So starting in 2026, they are going to have to specifically identify the amount that is eligible for this deduction. Again, 2025 is a transition year, so they do not have to do that, and you can use any reasonable method to determine it. So again, you're going to look at that IRS Notice 2025-69 for details. Section 7 of the FLSA requires overtime to be paid at a rate of at least 1.5 times the employee's normal wage. So we call that time and a half. Therefore, as we said, only the extra 50% over the normal wage is deductible, even if the employee is paid more. So for example, if they get double time, they still only get a deduction for the 50% over their regular rate. Also, it has to be overtime required by Section 7 of the FLSA. Some companies will pay overtime that is not required by the FLSA. That overtime does not qualify for this deduction. Some states require overtime in situations that the FLSA does not require overtime. Those amounts cannot be deducted. So for example, some states say if an employee works more than 8 hours in one day, you have to pay them overtime for the extra hours over 8. The Federal Labor Standards Act does not say that. It's based on 40 hours per week. So as long as the employee works 40 or fewer hours for the entire week, they're not entitled to overtime under the FLSA. So if you have a state that requires overtime for more than 8 hours in a day, for example, that does not qualify for this deduction. But mainly what you'll want to remember for the exam is it is overtime paid pursuant to Section 7 of the Fair Labor Standards Act. So let's look at a couple of examples. Travis works 200 hours of qualifying overtime during the year. His normal hourly rate is $20 and his overtime is paid at $30. Therefore, he received $6,000 for those 200 hours of overtime. He is single and his adjusted gross income is $50,000. How much is his qualified overtime deduction? Well, it is $2,000. So it's 200 hours times the extra $10 per hour received. And it can also be computed as 1/3 of the $6,000 he was paid. Since it was time and a half, 1/3 of his pay is the deductible portion. Our next example. Still Travis, still working 200 hours, but now he gets double time instead of time and a half. So he gets $40 per hour for his overtime rather than $20 per hour. So therefore, he received $8,000 for those 200 hours of overtime. How much is his qualified overtime deduction? Well, it is still $2,000 because even though he was paid double time, he only gets to deduct the time and a half because that is what is required by the FLSA, is time and a half. So it is still $2,000. In this case, you cannot just divide the $8,000 by 3. It doesn't work. It only works if it is time and a half. Our next deduction is the new car loan interest deduction, again for 2025 through 2028. This deduction is for up to $10,000 for qualified passenger vehicle loan interest, and it does phase out, and these are different phase out amounts. So it starts to phase out when adjusted gross income exceeds $100,000 or $200,000 married filing jointly, and the deduction is reduced by $200 for each $1,000 of adjusted gross income over the threshold. It's for interest paid or accrued on indebtedness incurred after 2024 for the purchase of and that is secured by a first lien on an applicable passenger vehicle for personal use. So it had to be a loan taken out in 2025 in order to be deductible in 2025. It had to be secured by a lien on the vehicle, and it had to be an applicable passenger vehicle for personal use. So what is applicable passenger vehicle? First of all, it has to be new car or vehicle with at least 2 wheels designed for use on public streets. So you're talking about your typical car, minivan, van, SUV, pickup truck, or motorcycle. The gross vehicle weight rating has to be less than 14,000 pounds. So it is your typical passenger type of vehicle, and the final assembly must have been in the United States. So it could be a foreign brand of car. As long as it was assembled in the United States, it qualifies. Or it could be a domestic brand of car, but if it was assembled in a foreign country, it does not qualify. So it's where final assembly takes place that counts. It includes a refinanced loan as long as that is not more than the balance of the old loan. And qualified interest does not include lease financing. So if you've got a lease, it does not qualify. Does not include interest paid to a related party. And it does not include interest on vehicles that are not for personal use or for fleet sales or for vehicles with a salvage title or intended to be used for scrap or parts. You must include the VIN, the vehicle identification number, on the tax return. And if you paid $600 or more of interest, then you should receive a statement from the lender. In the future, in 2026 and beyond, the lender is going to have to report that both to the consumer and to the government. For 2025, they do not have to report it to the IRS, but they still should be sending the taxpayer a statement as long as that taxpayer paid more than $600 in interest. And then the last of our new deductions is the enhanced deduction for seniors. This was added by the OBBBA, and it was put into place instead of no tax on Social Security. You may remember during the presidential campaign, that there was this talk about that there's not going to be tax on Social Security anymore. Well, that did not go through. We'll talk about Social Security in a later video, but it is still subject to income tax. What they did instead was they added this deduction for seniors, but it has nothing to do with Social Security. So it is a deduction of $6,000 per person who is age 65 or older, but you do not have to be receiving Social Security in order to get it. If you are age 65 or older, you get the deduction. If you are under age 65, you might be receiving Social Security. You can get normal Social Security at age 62 if you want to, but you would not qualify for this deduction. So this is for people who are age 65 or older. The $6,000 is not adjusted for inflation, and it is reduced by 6% of modified adjusted gross income that exceeds $75,000 or $150,000 if you are married filing jointly. And the deduction is not allowed if you are married filing separately. And again, you must have a Social Security number and report it on the tax return. So let's look at an example. Patricia, 65, and James, 63, are married and file a joint return. Their modified adjusted gross income is $170,000. How much is their enhanced senior deduction? Well, here's how we compute it. Patricia is the only one age 65 or older, so their maximum deduction is going to be $6,000. However, they have to reduce that by 6% of the amount that their AGI exceeds $150,000. So their AGI is $170,000 minus $150 is $20,000 times 6% is $1,200. Subtract that from the $6,000, and so their final deduction is $4,800. Now we will move on to our final topic in this video, which is the Qualified Business Income Deduction. The general idea of the QBID is fairly simple to grasp, and for most taxpayers, it is simple to calculate. For higher income taxpayers, it does get more confusing. I am going to go over all of it in this video. However, I am going to give you a choice or offer you a choice in how to study for this. So we'll get to that a little bit later. I just want you to keep in mind, again, general idea is simple. It only gets complicated in certain circumstances for high income taxpayers. So let's see what we're talking about here. So business owners may be eligible for a deduction of 20% of their qualified business income plus 20% of their real estate investment trust or REIT dividends and publicly traded partnership or PTP income. So there's two components. So we'll be talking about this. You've got your qualified business income component and your REIT and PTP component. In order to qualify, you do not have to actively participate in that business. If it is a qualifying business, even if you do not actively participate in the business, you can take the deduction. So this is called the Qualified Business Income Deduction or the QBID, or sometimes you will hear it called the 199A deduction or the 199 Cap A deduction because this is a capital A. But no matter what you call it, it's the same thing, the Qualified Business Income Deduction. And it is available whether you itemize deductions or you take the standard deduction. It is a below-the-line deduction. As we said, the deduction has two components. The first component is the QBI component. This component equals 20% of qualified business income from a domestic business operated as a sole proprietorship or through a partnership, S corporation, trust, or estate, but not a C corporation. So any business that's run other than as a C corporation qualifies. And again, we'll get into the difference between C corporation, S corporation, etc. in part 2. This component, the QBI component, is subject to limitations based on the taxpayer's taxable income and type of business. So that's where we said it can get more complicated. But again, the basic idea is pretty simple. 20% of your business income is deductible. The second component is the REIT or PTP component. So this is 20% of dividends that you get from a qualified REIT or income that you get from a PTP. It generally does not have the same limitations that qualified business income does, except for this one exception for PTPs. They could have an additional limitation, but that is going to be an unusual case. But again, the basic idea is very simple. REITs and PTPs are usually investments that you make much like buying a stock on the stock market. So you buy those and you get dividends. What we're saying is 20% of those dividends that you receive are deductible as part of the qualified business income deduction. When you add these two together, QBI component and your REIT PTP component, there is an overall limitation that we always need to keep in mind. So the overall deduction is limited to 20% of your taxable income minus capital gains. So if you got $150,000 of taxable income and $50,000 of that is capital gains, then your overall qualified business income deduction is going to be limited to 20% of $100,000 or $20,000. So no matter what amount you compute up here, you would only be able to deduct $20,000 maximum. And we'll show you how this works in some examples. Rental real estate. So we said for the qualified business income deduction that it has to be a trade or business. Rental real estate is generally not considered a trade or business. And again, we'll get into more of that in later videos. But usually rental real estate, not a trade or business. However, there is an exception. Solely for purposes of the qualified business income deduction, many rental real estate activities will qualify. So they'll be treated as if they were a trade or business. In order to qualify, you have to keep separate books and records for each rental enterprise, and you have to put in 250 or more hours of rental services each year for at least 3 out of the last 5 years. Or if you've only had the activity for less than 4 years, then it's every year. So in other words, you have to be actively involved in this business. It is not a passive type of activity. So remember, we said with other trades or businesses, you did not have to actively participate, and that is true. But if you're going to count your rental real estate activity as a trade or business for this purpose, you do have to actively participate. And the way you show that is by putting in 250 or more hours in at least 3 of the last 5 years. And you have to keep records of the work that was performed and what you did and when you did it, etc. Also, rental or licensing of tangible or intangible property that does not rise to the level of a trade or business will also qualify for the QBID if the rental or licensing of the property is to a commonly controlled trade or business. So what does this mean? It is very common for small business owners to rent property that they personally own to their business. So for example, they may own as an individual a building and then they rent that building to their business. That is perfectly legitimate. They can do that. The business then would deduct that rent to determine their net income. What this is saying is they are going to allow that business owner to add back that rent. So they received that rent as an individual. They have to pay tax on that. So what this is saying is they're going to count that rent that they received as business income. So they can add it to their income for purposes of taking the qualified business income deduction, which is good because that gives them a larger deduction. You could also have intangible property. So for example, a patent. Someone may invent something, get a patent, and have that in their own name, and then they rent that or they license that to their business. Same idea. They can add that licensing income to their business income for purposes of computing the QBID. So how do we compute qualified business income? Well, usually it's pretty easy. It is essentially the net business income from the business. So it's the net business income from any domestic trade or business, means a United States-based business, including income from partnerships, S corps, sole proprietorships, certain trusts, but again, not C corporations. So it's your normal business income. It does not include investment income, such as capital gains, even if it's on business property, does not count. Does not include interest, dividends, and of course, if you receive wages, that is not business income. So you cannot include that. You will see there is this exception for a statutory employee. We'll learn more about that in part 2. I would not worry about it for part 1 of the exam. The main takeaway here is it has to be normal business income, does not include investment income. It does include, though, the deductible part of self-employment tax, self-employed health insurance, the tips deduction, and deductions for contributions to qualified retirement plans. So remember, we talked earlier in this video about adjustments to income. So half of your self-employment tax you get to deduct. Your self-employed health insurance you get to deduct. Qualified tips you received you get to deduct. Contributions to qualified retirement plans you get to deduct. And you're deducting those not on, for instance, Schedule C as a business expense. You are deducting those on your 1040 as an adjustment to income. What this is saying is you have to treat those as business expenses. So you have to reduce your business income by the amount of those deductions. And we're going to show you an example here so you can see how all of this works. Also, previous year's net business losses are deducted from current QBI. So if you got a deduction in a previous year for a business loss, that is going to reduce your current year business income for purposes of computing the qualified business income deduction. So let us look at that example. Monique is single and operates a business as a sole proprietorship. Calculate her qualified business income based on the following income and deductions. So here is her relevant income and deductions. She had business income from Schedule C of $70,000, interest income on a business savings account of $1,000, capital gain on the sale of a business asset of $2,000, self-employed health insurance deduction on her 1040 of $10,000, deduction on her 1040 for 1/2 of her self-employment tax, which totaled out to $4,946, and then a deduction on her 1040 for her contribution to her SEP IRA of $5,000. So how much is her qualified business income? It is $50,054. So you start with her $70,000 Schedule C income, and then you subtract the self-employed health insurance deduction, the self-employment tax deduction, and the retirement plan deduction. The $1,000 of interest income and $2,000 of capital gain are not included. That's investment income. Even though it is interest income on a business savings account, it is still investment income. So you do not include it. And even though the capital gain was on the sale of a business asset, it is still investment type of income. You do not include it. So you're going to take $70,000 minus $10,000 minus $4,946 minus $5,000. That equals your $50,054. Now that we know qualified business income, we need to calculate the qualified business income deduction. If the taxpayer's taxable income is below these levels, $197,300 or $394,600 if married filing jointly, those are very important numbers. We're going to be talking more about them, but you definitely need to know those for the exam. But if your taxable income is below those amounts, then there is no QBI limitation. You simply take 20% of your qualified business income. So this is going to be most taxpayers. Remember, I said for most taxpayers, it's easy to calculate. And that's because most taxpayers are going to be below this level of taxable income. So you just take their qualified business income, you multiply by 20%, and that is the QBI component of the qualified business income deduction. Now, of course, we still are going to have that overall limitation of 20% of their taxable income minus capital gains. But for the QBI component itself, there is no limitation as long as the taxable income is below these amounts. If the taxable income is over these amounts, then the deduction may be limited, and that's where it gets more complicated. The deduction is even more limited than normal for a specified service, trade, or business. So if you have an SSTB and your taxable income is over these amounts, then you are going to be limited, and you are going to be limited more than if you had a different kind of business. So what is a specified service, trade, or business? It is a business in the areas of health, law, accounting, actuarial services, performing arts, consulting, athletics, financial services, and some others, but it does not include architects and engineers. So basically, it's a profession where you are making your income primarily based on your personal services or your brand. That's a specified service, trade, or business. If you are in one of those businesses and your taxable income is above these limits, your QBID is going to be more limited than someone who is in a different type of business. So that leads us to the more complicated material. And here is where I am going to offer you a choice. I am going to give you a short course, and then I am going to extend it into a long course. You can choose, if you want to just study the short course, or you can choose to study both the short course and the long course. This will be easier to explain by showing you a chart. So, for the qualified business income deduction, as we already said, if your taxable income is below those numbers, 197,300 or 394,600, married filing jointly, then it's easy. You just take your qualified business income times 20%, and it doesn't matter what type of business you have. SSTB, non-SSTB does not matter. However, if you have higher income, so if your income is over these amounts, it's 247,300 or 494,600. So if your income is over those amounts, if you are an SSTB, you get no QBID. So if your income is under the 197,300, you get 20%. If it is over 247,300, you get nothing if you are an SSTB. For all other businesses, if you're under the 197,300, you still get your 20%. If you are over 247,300, then the amount of your deduction could be limited based on what is called the wage UBIA limitation that we will be talking about. This is what I'm going to teach you in the short course, and it is fairly straightforward. I estimate that at least 90% of the questions that you may get on the exam about the QBID, you will be able to answer just by learning the material in the short course. So what we've already learned up till now, and then what I'm going to show you in the short course will allow you to answer, I estimate, at least 90% of the questions. Then we're going to get into the long course. You may not, but you may get a question on the exam that requires you to compute a qualified business income deduction based on the material in the long course. So it is up to you whether or not it is worth your time and brain power to learn what is in the long course, because it is somewhat complicated. It's not terrible, but it's not something you're going to learn just by listening to this video. You're going to have to spend some time with it in order to really understand it. So you could have a couple of different approaches. You could just say, I'm going to learn the short course, and if they give me one of these questions that's in the long course, so be it. I'll just guess and I'll move on, and I'll probably miss that question, and I'm okay with that. That is one choice. By the way, if you will just listen to the long course, you may pick up enough to at least make an educated guess on that question. You might be able to narrow it down, say, to 2 answers rather than 4. So then you've still got a 50-50 chance, but you have to assume that you're probably going to miss that question, and you have to be okay with that. So that is one course of action you could take. The other course of action is for those of you who say, no, I want to get every answer right. I want to know how to do this. That's great. That's fine. I admire you for that. In that case, you are going to want to know the long course. Not only are you going to want to watch this video, you're going to want to practice with this and make sure you actually understand how to do these calculations. So the choice is up to you. So listen to the rest of this video, listen to both the short course and the long course, and then you can make your decision. So with that, let's start the short course. We'll start with the simplest of all, which is the QBI simplified computation. This again is for those taxpayers with taxable income below those amounts, the $197,300 or the $394,600. And note, of course, the $394,600 is twice as much as the $197,300. So again, if you know the $197,300, then you can just multiply by 2. Or if you know the $394,600, you can just divide by 2. But those are the amounts. That's the magic number. If you're under those, as we've said a couple of times already, it's very easy. Doesn't matter what kind of business you have. It's qualified business income times 20%. Then you're also going to look at any REIT or PTP income you have. Take 20% of that and add it together for your qualified business income deduction. Then you've got that overall limitation that we talked about, which is 20% of your taxable income minus your capital gains. If this is your situation, which this is going to be the situation for most taxpayers, you will compute this on a Form 8995, which is the Qualified Business Income Deduction simplified computation. And here is what that form looks like. So you can see at the top here, you are going to list your trades or businesses. Oftentimes, it's just going to be one. They've got one Schedule C. You're just going to put that on here, put on the taxpayer identification number, like the employer identification number, and then the amount of the qualified business income. And then the rest of the form is simply going to walk you through the 20% and then adding your REITs and your PTP income and the 20% of that. And it's going to add it all together, and then that is going to flow forward to your Form 1040. So let's look at an example. Cedric is single and has taxable income without regard to the qualified business income deduction of $160,000, which includes $5,000 of capital gains. He has no investments in REITs or PTPs. He has qualified business income from a Schedule C business of $125,000 after taking into account all of his deductions. He also invested in a friend's S corporation, but he does not materially participate in that business. His share of the QBI from that business is $40,000. What is his qualified business income deduction for the year? Well, the first thing we know is he's under the $197,300. So we know we've got a simplified computation. We're just going to take 20% of his qualified business income. So what is the answer? It is $31,000. So he gets 20% of the $125,000 Schedule C income and 20% of the $40,000 S Corp income. Remember, he does not have to actively participate in the business in order to qualify. So that totals $165,000 times 20% is $33,000. But remember, we have this overall limitation, 20% of taxable income before the QBID minus capital gains. So that is 160,000 minus 5,000, which is 155,000 times 20% equals $31,000. So his qualified business income deduction is $31,000. Even that example is more complicated than most of them you are going to see in real life. In real life, you're usually going to see just the Schedule C, no REITs or PTPs. You're just going to multiply it by 20%, and that's going to be it. Of course, we're always going to test it against the 20% taxable income number. But that, as you can see, really is pretty simple, which is why they call it the simplified computation. So now let's move on to the higher income taxpayers. If their income is above those levels, the 197,300, 394,600, then the deduction may be limited. In order to determine the amount of the limitation, it is going to depend on the type of business, whether or not it is a specified service, trade, or business. If you have one of these higher income taxpayers, you cannot use that 8995 we just looked at. Instead, you have to use this 8995A, which is the Qualified Business Income Deduction form. If it is an SSTB, you are also going to use Schedule A of the form 8995A. So we will look at those later. Let's start by talking about a non-SSTB. If their income is over $247,300, or if they're married filing jointly, it's over $494,600, then the qualified business income deduction is going to be limited to the greater of 50% of your share of Form W-2 wages paid out in the business, or 25% of your share of Form W-2 wages, plus 2.5% of the unadjusted basis immediately after acquisition of qualified property. So a couple of things here. First of all, these numbers, 247,300, that is exactly $50,000 above the 197,300 that we talked about before. 494,600 for married filing jointly is exactly $100,000 more than the 394,600 that we talked about before. So if you are under the 197,300 or 394,600, we already know how to do it. It's 20% of the QBI. Now we're talking about if you are over these amounts. So if you've got more than $50,000 more than that 197,300, or you've got more than $100,000 more than that 394,600, then you are going to have this limitation. And again, this is for a non-SSTB. You are going to have to compute 50% of the wages paid out in that business. That is not 50% of the wages that were paid to you if you're an employee of that business. It has nothing to do with that. It is total wages paid out to all employees. If you are receiving this information from an S Corp or a partnership or a trust or an estate, this will actually be given to you on the K1. The K1 will say, here is your share of W-2 wages. Here is your share of UBIA, this unadjusted basis immediately after acquisition of qualified property. It will tell you those amounts. If it is Schedule C, then if you paid out any wages, you're just going to take the wages number. That's your W-2 wages amount. And then you're going to have to compute this UBIA. So your deduction, you're going to compute your deduction just like you always have, 20% of qualified business income. But then you also have to compute this because your deduction is going to be limited to the larger of these two things. First one, very simple. W-2 wages times 50%. Second one, slightly more complicated. 25% of the wages plus 2.5% of UBIA. What is UBIA? This is the amount of depreciable assets that you are using in your business. To determine the amount, we're going to look at how much you paid for them originally. So it's your unadjusted basis on the date of acquisition. You may have a bunch of office furniture and fixtures and machinery and equipment that you use in your business. And let's say you bought it all at the same time. And when you bought it, it all cost $20,000. Since that time, you may have taken depreciation. So that depreciation lowers your basis in those assets. But for purposes of this, we don't care about that depreciation. All we care about is how much did you pay for it originally? You paid $20,000. $20,000 then is your UBIA. It is your unadjusted basis. So you don't take into account any depreciation. And it is that basis immediately after acquisition. So you bought it, it was $20,000. That is your UBIA. Now, there is this limitation that that property is still within its original class life. What does that mean? In part 2, we're going to learn all about depreciation and class lives and all of that. Class life is kind of an estimated useful life. And the IRS has all these tables and charts that tell you for various types of assets, here is the class life. So, for example, furniture, fixtures, and equipment is generally going to have a class life of 7 years. So, what this is saying is, as long as you bought that $20,000 of equipment within the last 7 years, you get to count $20,000 as your UBIA. If it was longer ago than that, so it's no longer within that class life, you do not get to count it as UBIA. And then if you happen to have property that has a useful life or a class life of longer than 10 years, you only get to use 10 years. Even if that property is, let's say, 15-year property, you only get to count it if it's within 10 years. So again, for most taxpayers, this is easy. Explaining it is more complicated than actually figuring it out. So for most businesses, you're going to be able to figure out, okay, here's the asset, here's how long you've had it, here's how much it costs. It counts as your UBIA. And again, if you're getting this from an S Corp or a partnership, they're going to tell you right on the K1 the amount. So we're figuring out this limitation. We're going to take the larger of these two, 50% of your wages or 25% of your wages plus 2.5% of your UBIA. Now note this down here. This does mean that you could have a non-SSTB that does not get any qualified business income deduction. So if the taxpayer's taxable income is over these amounts and they have no wages, let's say it's a Schedule C business, they have no employees. So if you have a Schedule C business, you do not pay yourself wages. We'll learn about that in part 2, but that's not how it works. So you may not have any wages and you may not have any UBIA. Maybe all of the equipment that you use in your business is older. It's beyond its original class life. So you've got no wages and you've got no UBIA. Well, in that case, 50% of your wages is zero, and 25% of your wages plus 2.5% of your UBIA is also zero, which means your deduction is limited to zero. So it is possible for a non-SSTB to have zero qualified business income deduction if their taxable income is over these amounts. But for most businesses, if they have wages and or UBIA, then they will still get a deduction. It will just be limited to the larger of these two. And we are going to look at an example here so you can see how this works. But first, let's look at that 8995A form. So this is what it looks like. You are going to list the trades or businesses up here, and then this is where you're going to compute the amount of business income. And you are also going to put your W-2 wages and your UBIA and figure out that limitation. Then we've got page 2. Part 3, we're going to talk about in the long course. But in part 4, you're just going to take the information from the first page. You're going to add in your REIT and PTP income. That is going to give you your total qualified business income deduction, which will then flow over to the 1040. So let's do an example. Travis and Taylor are married filing jointly and have taxable income before the QBID of $500,000 and qualified business income of $320,000, and they have no capital gains. Travis's construction business, so it's not an SSTB, paid wages of $60,000 and had zero UBIA. What is their qualified business income deduction? So let's walk through this. First of all, we're going to check the threshold status. Is their taxable income over $494,600 because they are married filing jointly? Yes, it is. It's $500,000. Therefore, we know that they are going to be subject to this wage or UBI limitation. So we are going to calculate their tentative qualified business income deduction. So that's just like we've always done. $320,000 times 20% is $64,000. but we could have a limitation. So we have to calculate the wage or property limitation. It is the larger of 50% of wages. Wages were $60,000, so 50% of that is $30,000, or 25% of wages plus 2.5% of UBIA. So 25% of wages is $15,000. There is no UBIA, so that totals up to $15,000. We take the larger of those two, which obviously is $30,000. So we know right away that their QBID is not going to be $64,000. It is going to be limited to $30,000. Now, we always have the overall limitations. We want to test that. Taxable income minus capital gains is $500,000 times 20% equals $100,000. Obviously, $30,000 is lower, so we get the $30,000 deduction. Note here that it is possible that we could still get a $64,000 deduction. If you do this calculation and the larger of these two is more than $64,000, then you get the full $64,000 deduction. Usually, though, it's going to be less, especially if you have a question on the exam. It's probably going to be less. And so you're going to want to figure out this amount and what the limitation is. So that handles the qualified business income portion. So now all we have to worry about is the REIT or PTP portion. And again, this is easy. It's 20% of the dividends received from a REIT or the income received from a publicly traded partnership. And that's really it. Those amounts will be reported to you. You multiply it by 20%, and that is it. There is this one exception. If your PTP happens to be engaged in an SSTB, you could have a further limitation. And we'll be talking about the SSTB limitations in the long course. I would not worry about this for the exam. That would be pretty obscure. And then, other than asking a theoretical question about it, they're not going to ask you to compute that. So what you need to remember for the REIT PTP is it's just 20% of the amount that is received. Once you have those two, you've got your qualified business income component, you've got your REIT PTP component, you just add them together. That is your QBID. But then again, we have this 20% of taxable income minus capital gains limitation. So we always need to make sure we are aware of that. So that is it for the short course. It's really not that complicated. If you are under those taxable income limits, 20% of qualified business income. If you're over those increased amounts, if it's an SSTB, you don't get any qualified business income deduction. If it's a non-SSTB, then you have to compute that wage and property limitation. What you have learned so far, again, should help you to answer at least 90% of the questions on the exam. If you want to pick up the other 10%, that's where the long course comes into play. So now let's talk about that. The long course here, we're going to handle those situations where your income is in between. So it's higher than the 197,300, but it's below the 247,300, or the higher amounts for married filing jointly. So if it's under the 197,300, it's easy. If it's over the 247,300, it's fairly easy. If it's in between those two, that's where it gets complicated. And that's what we're going to talk about now. We're going to start again with a non-SSTB. So if your income is in between those amounts, 197,300 and 247,300, or 394,600 and 494,600, then your qualified business income deduction is going to be partially limited. Remember, if it's over those amounts, it's fully limited. If it's a non-SSTB, you've got the wage and property limitation. If it's under the 197,300, you don't have any QBI limitation. It's just 20%. If it is in between, you're going to have a partial limitation. So that limitation, that wage or property limitation, is going to be phased in based on a percentage. The percentage is, if you're not married filing jointly, it's taxable income minus 197,300 divided by $50,000. If you're married filing jointly, it's taxable income minus $394,600 divided by $100,000. So remember the spread. The spread is between $197,300 and $247,300. That's $50,000. So what we're trying to figure out is percentage-wise, how far over $197,300 are we? So we take our taxable income minus $197,300, divide that by that $50,000 spread. That gives us our phase-in percentage. And then similarly, for married filing jointly, it's a $100,000 spread. So we want to know percentage-wise, how far over $394,600 are we? So we take our taxable income minus $394,600 divided by $100,000. That is our phase-in percentage. We then multiply that phase-in percentage by that wage or UBI limitation that we already calculated. We already learned how to calculate it, same calculation. And then we subtract that result from the normal qualified business income deduction. In other words, the QBI times 20%. So let's look at an example. We're going to talk about Travis and Taylor again. Everything is the same, except now their taxable income is not $500,000. It is $464,600. They still have QBI of $320,000 and W-2 wages of $60,000 and zero UBIA. So what is their qualified business income deduction? So we are going to start with the threshold status. First of all, we want to know, do they have more than $494,600? No, they do not. They've got $464,600. So we take $464,600 minus $394,600 means they are $70,000 over that threshold. $70,000 divided by $100,000, that's a 70% phase-in percentage. Then we want to know their tentative QBID. So in other words, what is their QBID if there is no limitation? And it's the same as before. $320,000 times 20% equals $64,000. Then we're going to do the exact same calculation we did before. The wage and property limitation, the larger of 50% of wages or 25% of wages plus 2.5% of UBIA. So once again, we come up with $30,000. Now, though, we have to add in an additional step to the calculation. We are going to see how much does our normal QBID exceed our limitation. $64,000 minus $30,000 is $34,000. We then multiply that by our phase-in percentage of 70%. That gives us $23,800. We then subtract that amount from our normal QBID. So $64,000 minus $23,800 equals $40,200. That is going to be our qualified business income deduction. Of course, we always test it against 20% taxable income, but that is, of course, higher in this example. So our QBID is that $40,200. So we're not completely phased out like we were before to only $30,000. We're only partially phased out. So we get $40,200. So let's look at a recap of Travis and Taylor. If their taxable income had been under $394,600, then they would have had a full QBID. It would have been $64,000. If their taxable income had been over $494,600, so it had been at least $100,000 more than the $394,600, then their QBID would have only been $30,000. We would have had the full wage limitation. But then in our example, with their taxable income being in between, being $464,600, their qualified business income deduction was $40,200. So even if you don't want to invest the time to fully learn the long course portion of this, you can kind of understand how this works. If you get a question on the exam that fits into this category where their income is in between those amounts, you're going to have to look at the answer choices. One of the answer choices might be, if our example was used, one of the answer choices might be $64,000 or more. Well, you know that is likely not the answer. It is possible, but likely they're trying to test you on the limitation. So it's probably going to be less than that $64,000. And then you already know how to compute the wage limitation. You know that that's $30,000. So you know that it's going to be more than $30,000. So if they give you 4 answer choices, one of them is $64,000, one of them is $30,000, you can pretty much eliminate those 2 right away and know that the answer is one of the other 2. So now you got at least a 50% chance of getting it right. So that's the way you can kind of use this information, even if you don't want to go through all the trouble to really learn these calculations. But now let's move on to an SSTB. So if you have one of these SSTBs, again, if their income is below $197,300 or $394,600, it's easy, 20%. If it is above $247,300 or $494,600, it's easy. You get no deduction at all for an SSTB. But here on the long course, we're talking about what if it's in between. So what if you are in between those amounts? Well, again, we're going to use the exact same phase-in percentage that we used for a non-SSTB. The difference here is we have a further reduction. So you are going to apply that phase-in percentage to an adjusted wage and UBI limitation and subtract the result from an adjusted qualified business income deduction. So it is going to result in a lower QBID than for a non-SSTB. So we will look at an example, but first, let's look at Schedule A of the Form 8995A. You only need to use this form if you are dealing with a specified service, trade, or business. So what you will do is you will use this form. You'll start with your normal qualified business income. Then you are going to determine those adjusted numbers. Remember, I talked about the adjusted wage and UBIA number and the adjusted qualified business income deduction number. This is where you are going to calculate those. That will then flow over to the regular 8995A. So let's look at an example. Jason and Kylie are married filing jointly and have taxable income before the QBID of $464,600 and qualified business income of $320,000. They have no capital gains. Jason's law practice paid W-2 wages of $60,000 and had 0 UBIA. So the numbers are exactly the same as Travis and Taylor, except that we are dealing with an SSTB, a law practice. So how do we calculate their qualified business income deduction? These steps are going to be very similar, except we're going to add A, B, and C here. So we're going to start again with the threshold status. Their income is $464,600 minus that $394,600. It's $70,000 divided by $100,000, 70%, just like Travis and Taylor. But now we have to compute this applicable percentage in order to figure out our adjusted amounts. So first, we compute the applicable percentage, which is easy. It is 1 minus the phase-in percentage. So 1 minus 70% is 30%. That is our applicable percentage. We are then going to adjust our normal qualified business income by that amount. So our qualified business income was $320,000. Multiplied by 30% gives us an adjusted qualified business income of $96,000. We are also going to adjust our W-2 wages by that amount. So our normal W-2 wages are $60,000 times 30% gives us adjusted wages of $18,000. So now our tentative QBID is $96,000 times 20% is $19,200. Then our wage and property limitation is also going to be adjusted. So now we're going to take 50% of adjusted wages. So it's the $18,000 times 50% equals $9,000. And then our other test is 25% of adjusted wages plus 2.5% of UBIA. So that again is $18,000 times 25%, that's $4,500, plus 2.5% of zero is zero. So that is a total of $4,500. So we are going to use $9,000 as our limitation. Now the steps are going to be the same as with a non-SSTB, except we're going to use these adjusted numbers. So we take our excess amount. So we take our $19,200 minus our $9,000 limitation. That is $10,200. We then apply the phase-in percentage to that. So 10,200 times 70% is $7,140. And then our QBID allowed is our $19,200 minus our $7,140. That leaves us with $12,060. Of course, we always want to check it against 20% of taxable income, but the $12,060 is going to be lower. So that is our qualified business income deduction. So let's do a recap of Jason and Kylie. Again, if their taxable income had been under $394,600, would have been easy. $320,000 times 20%, $64,000. If their taxable income had been over $494,600, would have been easy. Their QBID would have been zero. But with it being in between, in our example, is $464,600, their QBID was $12,060. If you are one of those dedicated people that wants to really learn this, then you're going to need to go back over this, make sure you understand these examples, and then you're going to want to work some out for yourself. So get those forms, the 8995A and Schedule A of 8995A. Make up numbers and run them through the forms so you can really understand how this calculation is done. And so that is it for the qualified business income deduction. So some of you might be saying, well, you know what, that long course, that wasn't so bad. I'll go ahead and learn it all. Others of you might be shaking your head and saying, no way, I'm going to go with the short course. And either way is fine. It is completely up to you. I did want to show you this chart again, same chart that we saw before, but kind of come back to this to keep your head in the game about what we're talking about here. Less than 197,300 or 394,600, doesn't matter what kind of business, qualified business income times 20%. Over 247,300 or 494,600, if it's an SSTB, you get nothing. If it is a non-SSTB, you have the wage or UBI limitation. And then if you are in between those amounts, you are going to have a partial wage or UBI limitation. And that partial limitation is even further reduced if you have an SSTB. And that leaves us with taxable income. So we started with gross income. We subtracted our adjustments to income, which left us with adjusted gross income. Then we subtracted all of our below the line deductions, either standard deduction or itemized deduction. And then all of those new deductions that we have for 2025. And finally, we subtracted the qualified business income deduction, which leaves us with taxable income. And now that we have calculated taxable income, in video 5, we will learn how to calculate the tax itself and about tax credits. So that is the end of video 4. I will see you in video 5.